We're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions?
If we didn't have this banking crisis, then this would have been a more hawkish result.
How much will depend on how successful they are at ring fencing and limiting spread from the current situation.
The Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is.
The risk of a hard landing is higher now because the Fed isn't going to really know what's the appropriate policy to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Split-screened chaos in Washington, D.C.
Well said.
That was yesterday. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures nicely positive, up 0.5% on the S&P 500. Lisa, this market got into a difficult moment at one point yesterday afternoon, but it wasn't about Chairman Powell. It was about the Treasury Secretary.
That was what I found interesting. Chair Powell did an excellent job being really boring, basically towing a line that really didn't disrupt anything and left the market in pretty good shape. And then Janet Yellen came out and was like, yeah, about those deposits, they're not guaranteed. We haven't discussed it yet. We don't think that this is necessarily going to be on the table. And all of a sudden, and you can interpret those comments however you want. But the market clearly interpreted them as there was no backstop for deposits, as she had basically hinted at earlier. And that had a pretty big impact on some of those bank shares.
So earlier in the week, she possibly teed up using the systemic risk exception to make depositors whole. I think there's a key distinction here. There's a difference between doing that again and having blanket deposit insurance. I think the difficult part of this moment in this market yesterday is that the day before, people misinterpreted those comments, the underlying meaning of what she was really trying to imply.
She can't do that, though, on a longstanding basis without congressional support. And she was speaking to Congress. She was speaking to the Senate. And I think that that's telling. There isn't the congressional will to make this happen. So if she's talking about what her proposal is, what I'm curious about is whether we end up with a legislative stalemate that she's trying to reflect in terms of what her capacity is to do.
This was the point of tension for Secretary Yellen last week as well, when she was on Capitol Hill testifying. She can't square this circle. At the same time, you can sit there and say, if we have these kind of troubles again, and we think that there could be contagion, then we can have that systemic risk exception and make depositors whole. That's a big difference, between that and saying we're going to have blanket deposit insurance. The problem was for Chairman Powell, he comes out in the news conference at the very top and says deposits are safe, banks are safe, the system's robust. And at the very same time, Secretary Yellen is saying that. It's the conflict between the two at the same time. That's really poor scheduling. You know, when Chairman Powell's speaking, I don't know how this stuff works. So I'm going to speak to Anne-Marie a little bit later and ask her, how do these kind of things get scheduled? And can't they just reschedule them when they find out that she's going to be speaking at the same time as the Fed chair?
You would think, and I don't know that it's scheduling either, but I'll just tell you Steve Chiaverone's take on it because I thought it was quite funny. It's astounding that Yellen and Powell would have given contradictory messages on bank deposits at the same time. Powell essentially said that all deposits are safe. Yellen said, hold my beer. You would have thought that they would have coordinated. I mean, that really is the tell from the market.
We talked about this yesterday. You'd think they had spoken to each other, wouldn't you?
I mean,
clearly, why wouldn't they have spoken to each other?
The fact that they haven't doesn't exactly imbue you with incredible amounts of confidence that they have it all together.
It was kind of bizarre yesterday. Futures bounced though this morning, so let's whip through it. Equity futures up by 0.5% on the S&P 500. Bonds look a little something like this. On the Treasury curve, unchanged for once on a 2-year, 3.94. Yesterday, we had a 25 basis point hike from the Federal Reserve, and the 2-year yield, Lisa, dropped 20 basis points.
Well, and we heard from Fed Chair Jay Powell after Michael McKee's great question that they had no rate cuts priced in, and the market saying, yes, you do. You have almost 100 basis points of rate cuts priced in. At least that is the market pricing right now. So, you know, what people are believing, I'll leave that up to people to decide.
What's coming up?
What's coming up is more central banks. We have Turkey and the Bank of England following Norges Bank and the Swiss National Bank. Swiss National Bank just raised rates by 50 basis points. 11 a.m. we hear from Bank of England's Catherine Mann. She's speaking at the Peterson Institute as a panelist. The Bank of England expected to raise rates by an additional 25 basis points. And here's where I think we're going to start to see more divergence in the currency, more potential dollar weakness. This is what people are speculating, not incredibly, but if you start to see the Fed pulling back and European banks still seeing hot inflation further behind in terms of the rate hiking cycle, do you get this divergence where it's all systems to go on the rate hiking over in Europe and not so much in the U.S.? We haven't talked about this that much, but I think we should. 10 a.m., TikTok CEO is coming before the House Energy and Commerce Committee. John, you mentioned yesterday, what do we end up getting if we hear from politicians who just are basically using this as a campaign pitch point? There will be some tell, though, what the appetite is to actually do something on this front. I mean, I think it'll be interesting to see what proposals he has.
I'm surprised they haven't done anything already. This is a hangover from the previous administration. Why has this taken so long?
It's not popular. That's why. I mean, I can't think of anything else. They advertise. They do campaign advertisements on TikTok. So at what point can they basically square the circle, if you want to use a similar type of analogy? And at 3 p.m., we hear again the redux of Treasury Secretary Janet Yellen. Will she clarify her comments after tanking bank stocks yesterday with her lack of support necessarily of ongoing deposit insurance? I am watching the KBW Bank Index today. Do we see some sort of reprieve? Yesterday, ongoing concerns about First Republic, PacWest coming out saying that they got a line of credit, that they saw 20% of their deposits withdrawn in the first part of this year. How do we stave that off, especially if Janet Yellen is kind of waffling and giving contradictory messages to what we hear from Jay Powell?
You know what we've learned in the last week? People thought that the ECB had delivered the playbook for Chairman Powell. That's not the playbook he reached for. We've learned that Credit Suisse is not a substitute for rate hikes at the ECB. But the financial instability in America is a substitute for rate hikes at the Federal Reserve. That's a key difference. And to your point, you mentioned this a little bit earlier, that opens the door potentially for some divergence between what you expect from the ECB and what the Fed might deliver in the next couple of meetings.
And there are a lot of questions that emerge from that, but that to me is one of the big themes that's really a pivot point that's new.
Joining us now in this equity market, John Stolfus, the Chief Investment Strategist at Oppenheimer Asset Management. Hey, John, great to catch up with you, sir. I mentioned this during the commercial break. We're going to talk about exactly this. If the Fed backs away because things are breaking, are you telling me that's bullish?
It's certainly not a bad thing. Let's put it that way. And I think the market really responded to that intimation from Chair Powell. And I think that, that was all really doing quite well. And later on, we had this from Secretary of Treasury, Janet Yellen, and that kind of shook people up. But this is not uncommon. Times like this, the main thing, it's not so much what brings the market down, is how quick the response is, and a recognition investors need to realize not every response is going to be correct or exactly what they want to hear, but it's a process of working our way back out of another set of wooded areas, so to speak.
The setted wooded area we're going to get out of somehow with rate cuts. That's what the market says. The Fed says no. How much are you counting on rate cuts to have a more bullish outlook on how this emerges, how this develops, how we emerge from the woods of financial systemic issues?
Great question, Lisa. Not really relying on rate cuts a heck of a lot near term. I think the inflation is sticky. The Fed has to do something. Its credibility is still on the line, but its credibility is always on that line, whether it's a rate hike cycle or a cutting cycle. But in this particular instance, having been behind the curve badly enough, so we had this inflation hit the 40-year highs the way it had, this is an important period. And they've got to show that they can manage both this as well as a crisis in confidence within the regional banks. And I think they can, and I think they're very capable of doing it. But it doesn't mean they are infallible. They just have to work their way through a process.
John, you've been a bullish investor for quite a while. What does being a bull right now mean? What does it mean owning, and what does it mean hoping for?
Well, I think the main thing right now is, we've just been building our positions in areas that we think will be rewarded. And if I just take a look, and I hate to give the Bears, some areas they might hit, if they get bugged out today at some point. But it's been terrific, where all of a sudden tech has become the new value story. There was a recognition all of a sudden that indeed we're not going back to the abacus or going back to the slide rule. Technology is alive and well. The most important thing is it's got to be profitable. Positive cash flow is a good thing. But as well as that, it looks good for consumer discretionary. It looks good for areas, communication services, industrials. And this is the area where we like to invest, not play. A little bit longer on the financials now. This is going to take to regain trust in terms of investors who are not players, but rather intermediate to longer term investors. It'll take them a little while to feel more relaxed about financials as this gets cleared up.
Well, we need the consumer to relax about financials before investors can relax about financials. John, you need policy to act as a circuit breaker. Do you think this financial instability can end without blanket deposit insurance?
Yeah, I think that the real definition is will have to be perhaps a redefining about what that maximum amount of a deposit that gets covered, and then anything over that would likely have to be paid by the depositor in being over and having an overage versus what the covered amount is, so that the taxpayer is not really on the hook for it.
John Stolfus of Oppenheimer Asset Management. John, thank you. Lisa, what do you make of that?
Thanks.
I just love that he didn't want to give anything to the bears to chew on in any way, shape, or form. So he talked about how it might take a little longer for tech to come back, which is basically like, perhaps it will lag behind in the near term. I will say, though, what he's talking about is probably the bull case at a time where you still have optimism in the economy, you still have momentum, and you still have a story of resilience in a lot of sectors that even if you get, a rocky road over the long term, you could lift.
Can I ask that question of you? Can this end without blanket deposit insurance? Can this financial instability end without it?
It's a great question. I think without consolidation, mass consolidation, and perhaps a greater degree of regulation. Here's the question. Would these banks and would politicians rather have a greater degree of regulation that changes the business model and reduces the profitability case for lending? Or would they rather provide a backstop to depositors in a way that they really haven't before? And those are really the two issues that they're dealing with. Either way, there has to be some policy change to revive the confidence that they're not going to be subject to this. I mean, Jane Fraser yesterday basically saying this is a new terrain given the speed of which Silicon Valley failed.
Extra regulation is guaranteed, isn't it?
You would think so, but I can't imagine that a lot of people are going to be really gung-ho about that if that crimps their local regional bank. I mean, really, because these are very direct. It's like the Bundesbanks in Germany. Every politician has a Bundesbank, so they don't want to consolidate them. It's sort of the same in the U.S. with regional banks.
It's a nice analogy, comparison. Where'd you read that?
I just made that.
You just made it up. You just made it up on the spot. You're making things up.
Let's move on.
Are you making things up?
No, I'm not.
Okay.
No, it's true.
That's a good start to the morning. Don't worry, we haven't slept for a week. Futures right now on the S&P, positive 0.4%. Broward's going to make things up for the next 2 hours. Yields 348 on a 10-year, higher by 4 basis points.
She is quick on her feet, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Fed Chair Jerome Powell made it clear that inflation is still the top concern of the central bank. Less than 2 weeks after the second biggest bank failure in U.S. history, Powell advised that more Fed tightening may be in store following Wednesday's quarter-point rate hike. Officials are betting that the bank turmoil won't turn into a broader financial meltdown. The Bank of England is likely to continue the quickest set of interest rate increases in 3 decades. Investors and economists expect the BOE to raise the benchmark lending rate by a quarter point. Those expectations were solidified Wednesday when new data showed inflation climbing in the UK for the first time in 4 months. Treasury Secretary Janet Yellen says the U.S. is not considering blanket bank deposit insurance without working with Congress. Now, a Senate subcommittee had asked Yellen whether protections for all U.S. deposits would require congressional approval. She also said that the heads of recently failed American banks should be held accountable. The U.S. fears that a war-weary world may embrace China's Ukraine peace plan. This week, Xi Jinping and Vladimir Putin discussed the proposals, which the U.S. has still rejected. Still, dismissing it outright could let China argue to the nations tired of the war that the U.S. isn't interested in peace. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Live from New York City this morning. Good morning. to you all. Equity futures right now on the S&P 500 positive by about 0.25%, fading just a touch on the S&P 500. On the Nasdaq, we're positive 0.8%, a lift there after a big move again in the Treasury curve yesterday, down 20 basis points at the front end, even after a 25 basis point hike from the Federal Reserve, because we are going who knows where on the FOMC now. The median dot stayed unchanged at 5.1% from the December projections. Looking out ahead in the latest projections for March and the March meeting from yesterday, your 2-year at the moment 3.95, so south of 4 again. We're higher on the session by about a basis point, but much lower over the last month or so. The 10-year yield higher by 3 basis points, 3.4659. We're all fixated on the difference that's emerging now between the ECB and the Federal Reserve. Early on in the session, the euro 109.30 against the dollar. Right now 108.71, positive about 0.1%. Bramo, I'm with you. This is one to watch here. The language from Lagarde, nothing like the language from Chairman Powell.
This is a pivotal moment, I think, this week where we really see a difference in tone between Chair Powell, what we heard last week from ECB's Christine Lagarde, and all of the other ECB members who've come out and said, we still have a serious problem in inflation. And the fact that inflation data came in hotter than expected yesterday from the United Kingdom really gives them a very difficult decision today at 8 a.m. Eastern when they take a look at how much do they have to raise further to really curtail that momentum at a time when other areas are seeing some sort of disinflation.
That decision about 90 minutes away. Allow me to frame the different views around the Federal Reserve going forward from here. Morgan Stanley see and expect a final 25 basis point hike at the May meeting. They say it's going to be driven by another strong payroll print, sticky inflation, all of that good stuff, or bad stuff, however which way you see it. Needless to say, a surge in bank funding pressures could alter that view. That's the Morgan Stanley view. This is Neil Dutter of Renmac. When uncertainty is high, policymakers enter wait-and-see mode. We only get one jobs number between now and May. He says it's unlikely that's enough information to decide. I think this is the problem we have now. The totality of the data and this data dependence nonsense that we talk about all the time, dependent on what data? Now, I've joked over the last week, does it include bank stocks? But seriously, now the Federal Reserve has told you that financial instability is a substitute for rate hikes. To what extent, no one knows. They don't know either, and they've admitted that. What does that mean for CPI when it comes in, for payrolls when it comes in, on how we should adjust to these numbers if this issue's still ongoing?
Just don't mention it and it won't really be relevant. I think that, honestly, when you look at some of the analyses, they're saying there's going to be disinflation because you're going to get credit tightening. So this data all doesn't matter because it's all backward looking. How many more do we need to see before it matters again, before you start thinking about the other side of this? What's the risk, the binary risk of seeing the inflation potential over the longer term is suddenly surging upward because of a lack of conviction of we're going hard now?
I think the Fed's essentially put a number on this. Anyway, I do believe that because I said yesterday, if we had the SCP 2 weeks ago, that median dot for 23 was coming up 50 basis points. That was my thought at the time. I think everyone shared that belief to some extent. You'd go from 5.1 to 5.50. Yep. They were basically telling us they might have to lift the median dot. They might have to do more. Kashkari was running around saying 5.40. So I think we can all agree on that. The fact it stayed the same is them basically telling you, even though CPI was hot, payrolls were decent, that we are going to say, I think maybe 50 basis points of tightening is coming from this financial instability. Okay, when are you going to find out if that's true or not? Is a month long enough for you? Do you need 2? Do you need 3? Do you find that out by early May to make a call on what you need to do with monetary policy? The Fed's found themselves in a really, really tough spot, I think, when it comes to the next move.
And I would take it a step further. If they do wait a couple meetings, then what is the potential damage if they hike rates again, say come September, at a time when people are actually starting to see the effects take hold much more significantly, but inflation just hasn't come down enough?
Here's the Frances Donald take over at Manulife. Here's the quote from her. While the terminal rate is now more in line, the path for the rest of 23 and into 25 is substantially different. While Powell said that the base case did not include cuts, the market's base case certainly does. Who's right? Frances Donald joins us now. Frances, do you think they're done? And welcome to the show.
They might be done. Who knows? It could be another 25 basis points or nothing. But in the grand scheme of things, I don't think it really matters. The market already has a coin toss for this next meeting. What matters and what actually shocks my economic and inflation models is not another 25 basis points or not. It's how fast they cut and when they start cutting. So the conversation is going to have to shift, I think, in the next few weeks away from this next incremental meeting towards what does the path to the next 1 to 2 years look like? Because if the Fed is going to get its way, there's a significant mispricing. I suspect that the market is probably going to have to price in more cuts moving forward, and the Fed is going to follow.
What drives that? The economic data or further financial instability?
The two, and this was the big difference, Lisa. You talked about the difference between the ECB and the Fed. The ECB, President Lagarde told us there is no tension between the price stability and financial stability mandate. And even though Chair Powell implied the banking system is sound, he also was very clear that they were incorporating real economic impact from the banking stress through the lending channel. So we know that this is going to dampen growth moving forward. And indeed, anyone with an economic model, the day that we saw the first initial banking stress, clued in this is going to be a credit crunch. And we have a playbook for that. It's not good. It leads to recessions. It has every single time.
Francis, we've heard from executive after executive, this is not a credit crunch. This isn't a credit problem. This is simply a liquidity mismatch. How do you say to them, you're wrong, this is going to become a credit problem, as it always has with liquidity issues, versus, no, you're right, this is something that could be addressed with deposit insurance or other measures?
I just pull out my charts from before the banking stress issues, in which we already saw senior loan officers telling us that we were in a sizable tightening. This was happening before we experienced banking stress. So even if you want to say the impact is nil, I could still prove to you that we are actually seeing a wide range of data saying that credit is pulling back. And that's particularly important because the bull case for the U.S. economy has been the consumer is strong, and the consumer was being driven by releveraging. If that slows or stalls, then we have a momentum slowing. Is that Q1, Q2? Probably not. But our traditional leads and lags tell us that by Q4 of this year, we're in a significant soft patch. So my issue is, well, maybe the Fed goes 25 basis points or not. I think not at this juncture. But how quickly do they choose to respond? And it's possible that the hawkish take here is not the next meeting, but that they try to stay on pause as long as possible, given inflation in this soft patch is probably still a little uncomfortably high.
From what I'm hearing, Francis, it seems like the threshold has gone way down for cutting rates, at least what you expect in the upcoming months. How low do you expect the Fed to be able to cut rates, given that there is a disinflationary effect from some sort of credit contraction?
Well, that's right. We have playbooks for uncertainty shocks, which the banking system stress is. We have playbooks for credit crunches. But it's been a very long time, Lisa, since we had a playbook for low growth, but inflation still around 3 to 4%. The most important thing I heard from Chair Powell yesterday was actually his reference to long-term inflation expectations being anchored. And he said it was true for households, businesses, forecasters, and markets. And that may be the direction that Chair Powell and the Fed chooses to tilt towards, as we still see some cyclically high inflation. So even if they come to the end of the year and we have 3 to 4%, they may be able to say, listen, the long run concerns about inflation expectations becoming de-anchored, we no longer have those. We can tilt back towards the employment side of our mandate, because let's remember the Fed does have a dual mandate. We just haven't talked about the employment side in a very long time.
John and I were talking about this earlier, Francis. Do you think that rate cuts in this framework are going to be bullish, are going to be positive for risk assets?
Well, traditionally, the context around rate cuts matters, but we got to get through a recession first. I mean, there is a little bit of something we're seeing now where people are saying, well, the leading indicators of the leading indicators of the leading indicators are positive. But that's jumping the gun a bit. We still have to go through a re-rating of this economy to a lower growth environment, which means lower earnings growth, less activity, an employment shock, maybe jumping the gun just a bit more or a bit too much if we get too bullish on rate cuts at this juncture, given the context.
Hey, Francis, thank you. As always, Francis Donald there, just brilliant, over at Manulife Investment Management. A lot of people said President Lagarde did a good job. A lot of people said Chairman Powell did a good job. They did two very different jobs when you compare and contrast.
Jay Powell came out and basically opened up the door to the market retaining its view that perhaps it was done with the rate hiking cycle. That is effectively what they did by keeping the dot where it was and by talking about, what was it? There could be a firming.
Additional policy firming. Instead of ongoing increases anticipated.
How many people do you think Googled what firming meant yesterday? They were like, what are the contours of firming?
I thought that was a pretty elegant way of dealing with a complex issue. And I imagine it took a long, long time to come up with it when they had their board meeting.
Strengthening?
Look, I truly believe they made what they thought was the best decision at the time.
Agreed.
History's going to judge whether it was the optimal decision. And I said this yesterday. You can look like Burns or you can look like Trichet. You back away too soon, inflation rips, you have to come back in, you look foolish. Or you end up hiking into a bigger crisis. So it's too early for me to say that they've made the right decision. I don't know what the right decision actually is. We're going to find out in the next few weeks. And that's what they were up against yesterday, trying to work out whether this truly was the right decision, given what we're up against.
I think they did a great job expressing deep uncertainty and a complete lack of conviction and a sense of what they believe and that other people have their own beliefs. What I find interesting is that the market took this as a resounding endorsement of rate cuts. I mean, basically, that is the one takeaway is game on. And as Francis Donald was just talking about, the question now is how far do they go with the rate cuts in this particular cycle if inflation doesn't come down fully?
They didn't hide it. We said, has 2 weeks changed things? It's only been 2 weeks. They've told us that they think 2 weeks has changed things, that ultimately this will lead to tighter lending standards, that this is a substitute for rate hikes. To what extent, we don't know, but that's the direction of travel for them. I said yesterday, is this disinflationary, this shock in America? They've basically told us they think it is.
And to be fair, a lot of people agree with them, right? I mean, they were reflecting what I would say is the consensus right now, that things have changed in the past 2 weeks. And even if there is stability in the financial system, there will be some sort of restriction of credit. Money is more expensive for some of these regional lenders that really punch above their weight when it comes to credit lending.
Do you want to talk about streaming and sports? Just briefly, you'll often hear me complain about not being able to find the football games in the United States because there are 20 different streaming platforms, each with...
Yes, I've heard them.
Each with a home. Peacock for the Premier League on the weekend,
right.
Paramount for the Champions League stuff. I've got no idea where any of it is. Might be coming to a home near you in the UK. Apple is considering bidding for the streaming rights to a range of English football games, according to people familiar with the situation, a move that would step up its sports ambitions and increase competition with Amazon and Prime Video. This coming from Giles Turner here at Bloomberg this morning.
I love your hot take. So basically, you over in England, you're not escaping the,
I believe BT
Sport,
I think Sky Sports, I think Amazon has had a little dabble as well. So,
Good luck.
I don't care who hosts it. I really don't. I just want to know where to go for certain games.
Why couldn't there just be a menu? You like
I don't know.
Football.
I don't want to exit one app, find another app, and exit one app and find another app.
Someone right now is crafting a solution just for you.
I hope they do. Not just for me, but for everybody. Futures on the S&P, positive 0.25% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Worries over inflation trumped the recent banking turmoil as Fed Chair Jerome Powell rejected the idea of rate cuts and said that more tightening may be ahead. Wednesday's quarter-point rate hike comes less than 2 weeks after the second biggest bank failure in U.S. history. The Swiss National Bank raised its interest rates by 50 basis points and indicated that there's more to come. The SNB signaled that inflation outweighs any concerns after the market reaction to the downfall of Credit Suisse. Meanwhile, SNB Chairman Thomas Jordan says that Swiss banks are not exposed to U.S. bank failures. Top executives at First Republic Bank have agreed to forego their bonuses for 2023 and some other pay. The bank has lost more than 88% in market value this year, and it's grappling with a crisis in confidence in some regional banks. Washington and the banking industry have been trying to keep First Republic from becoming the next bank to collapse. It's a victory for Boeing in Japan, the nation's flagship carrier, Japan Airlines. It's agreed to buy 21 737 MAX jets. Airbus was originally seen as the front-runner for the sale of the 320 Neo aircraft. The Boeing order is estimated to be worth about $1 billion. And there's a late twist to the sale of world-famous football club Manchester United. Bloomberg's learned that bidders have been granted extra time to come up with new offers. A Qatari consortium has already raised its offer above its initial $5.5 billion bid. British billionaire Jim Ratcliffe's first bid was below that. I'm Lisa Mateo. This is Bloomberg.
The government does recognise that there is some volatility in the market, but we believe the UK financial system is fundamentally strong and UK banks are well capitalised. They now have core capital ratios that are 3 times higher than before the 2008 global financial crisis, but we continue to monitor the situation carefully.
Jeremy Hunt there of the UK, the Chancellor of the Exchequer on the banking system in the United Kingdom. It seems to me, Lisa, if you're a Finance Minister, a Treasury Secretary, a Chancellor, you've got to come out at the moment and say how strong your banking system is. That's never good.
That's not a good thing, especially when it's literally all over the world. You can see every central bank with the obligatory, our banking system is sound. We are not the United States. Read between the lines. We don't have a regional banking crisis.
We are well capitalised and all of the above. The problem for the UK this week hasn't come from the financial system. It's come from the data. Inflation back to double digits. And I think this is the problem of a central bank trying to back away from rate hikes. Elisa, you're confronted with the economic data again, and they got slapped around the face by CPI at 10.4%.
And this is the reason why really the theme of the moment is how much divergence does there have to be from central banks that are dealing with inflation that in some places has peaked out, in other places really hasn't. And there really are a sense of differences between the different inflationary drivers in, say, the United Kingdom versus the US.
Looking for a move to 4.25 today from 4%, looking for a 25 basis point hike from the Bank of England. Joining us now is Jennifer McKeown, the Chief Global Economist at Capital Economics and the former BOE economist as well. Jennifer, thanks for being with us. Let's start here. The best decision today, what is it?
Oh, difficult one. I think it probably is best to press on with another 25 basis point hike, just particularly given those inflation data that we saw yesterday, the strength of food inflation and the effects that that's having on services inflation in the UK are a particular concern. But I think it's a much closer call than the market seems to think, than market pricing seems to imply at the moment. It's worth remembering that its last meeting, which actually seems a very long time ago now, but at the start of February, that the Bank of England was the clearest of the major central banks in indicating that it was close to the end of its tightening cycle, that further tightening would depend on the data being stronger than it had expected, either on the inflation or activity front. So I think it is a fairly close call.
Do you think that even if they do hike by 25 basis points, Jennifer, that they will indicate, sort of as Fed Chair Jay Powell did, at least this is how he was read in the markets, that they are now at the end of the rate hiking cycle, and now it's just a matter of when they start cutting?
Yeah, I think it will be a fairly dovish tone, pretty similar to the one that we've seen from the Fed. Actually, the Bank of England is a bit different in that quite a few of its rate hikes have been on the relatively dovish side, and I don't think this one will be any different to that. There are clearly big risks to the economy in the UK, and those have intensified with the turmoil in the banking sector. There's got to be a good chance that credit conditions tighten much more aggressively in the months ahead. The Bank of England will very much have an eye on that and the possible implications for inflation in future. A lot of the commentary is trying to separate the two things, and for now I think central banks are trying to do that too and say, look, we're still serious about the inflation fight, we're going to continue raising interest rates, but ultimately in the future, if credit conditions tighten, then that brings down inflation too, so these two goals become aligned at some point.
Jennifer, every single central banker has tried to draw a distinction between their banking system and the one in the U.S., their banking system and how it is much more secure than, say, those that could be subject to deposit outflows. What about in the United Kingdom, where there is a unique set of issues, particularly how tied to interest rates some of the mortgages and other debt really are, where they adjust in real time?
Yeah, well, it's right about the banking system that it's very well capitalised, but that doesn't really help you if there are massive deposit outflows. It doesn't matter what bank you are or how strong your position is. If your deposits leave, then you're in trouble. What we've got to hope is that the fact that capital ratios are relatively high, that the banks appear to be in good health, will prevent that loss of confidence that would lead deposits to leave. Yes, the UK real economy is relatively exposed to what's happening to interest rates. The feed through should be relatively rapid, but there has been quite a shift in the UK from the variable rate mortgages on which we used to rely very strongly, unlike the US, towards a bit more of fixed rates and longer term rates. So that pass through isn't quite as quick as it was, but that's a good thing and a bad thing. In some sense, that just makes you think that even more of the drag from the policy tightening that we've already seen is yet to come, as it does start to feed through to the real economy. So that's just another reason, really, for the Bank of England to act with caution.
In fixed income, we'd call it a maturity wall. You know all this stuff, Jennifer. In high yield, we'd say, when does everyone have to face that moment where they have to go out there and issue debt because other things are maturing? Jennifer, is there that cliff edge moment with fixed rate mortgages? Is it a 2-year, 3, 5? What's the average one in the UK? Where is that moment?
Yeah, I think it's around 2 years now, but where that moment is extremely difficult to judge, unless you know when everybody's mortgage is maturing and when they might decide to remortgage for reasons of their own. But our sense, having dug through the data, is that probably only around a third of the impact of policy tightening has already come, and there's probably another 2/3 to go if we assume that we get another hike today, and also that the effects of the previous policy tightening are feeding through.
This goes to the long and variable lags question. Are they longer, shorter in the UK versus, say, the United States versus Europe? How do you think about that issue?
Yeah, I think they're probably still shorter in the UK than they are in the US, partly because of the fact that the kind of very long-term fixes on mortgages are not so common. But it's massively uncertain. The other thing about these lags is that we know that they're variable, they're quite long, but also they're very, very unclear. So central banks are very much reliant on watching the data and watching what's going on, not just in the real economy and inflation, but also in financial markets and in the banking sector, to judge just what the effects of their previous tightening have been. And I think the banking turmoil that we're seeing now is a clear indication of some of the effects of this past policy tightening, even though it was difficult to pinpoint in advance just how it would play out.
Jennifer, I think a lot of people would agree with you that the lags are shorter in the United Kingdom simply because of the structure of a lot of the debt. So is there a warning in that for what the potential ramifications for inflation could be, especially given the fact that we just saw an upside surprise in inflation in the United Kingdom, even after all of the hikes that have been implemented?
Yes, there's a warning in it, and the bank's going to need to act with caution. And I think that's probably one reason why, although in terms of the inflation data, it was clearer that inflation was turning down in the US, 6 weeks ago at the time of the bank's last meetings. And yet the Bank of England was the one that said more clearly that it was reaching the end of its tightening cycle and that the coming moves would be very data dependent. So I think that's probably a reflection of this to some extent, the fact that the pass-through is relatively rapid. The economy is quite reliant on the banking sector too.
Jennifer, thanks for the insight. Jennifer McKeown there of Capital Economics, about an hour and 6 minutes away from that Bank of England rate decision. The UK gets so much attention. Why are we talking about France? Have you seen that mess playing out in Paris at the moment?
With all the strikes?
Unbelievable.
Literal
Forcing
mess.
through a lift, raising the retirement age from 62 to 64. I was just looking at some of the news around French airports. One airport in Paris, the Civil Aviation Authority asking the airlines to cut flights by 30%. By 30%.
And if you take a look at the cost of hotels, I feel like I'm sitting in Tom's seat, so I have to mention the cost of hotels in Paris. But, everything is getting more expensive because there are fewer workers and there's fewer availability at a time when they kind of need the tourism and they need some of that to keep the growth going. There is a question of why you're seeing so many more with strikes, so much more labor upheaval, what this means for wages, what this means for the stickiness of inflation at a time when perhaps, yes, it's being transmitted through monetary policy, but there are structural forces underneath the economy that we can't forget about that are prompting increases across the board in wages and in prices.
Well, I think actually it's the model, the French model, this socialist model, that right now, given what we're facing in this economy, they've got to make clear changes, and that's why it was forced through by Macron.
And the reason why I think people talk about the UK right now in tandem with this type of situation is because you're seeing strikes in the UK that you hadn't traditionally seen, that are more akin to what you would see in France. You disagree?
No, I'm just saying, we still pick up the trash. London.
So you're not going to go to
London's
Paris with heaps of
London's
trash?
pretty tidy. It's clean.
What do you feel about New York City?
New York? Mm-hmm. It's pretty tidy. It's clean.
Do you really feel that?
It's pretty tidy. It's clean.
It depends.
What would you like me to say?
Hey, can I tell you something?
Have you got different thoughts on New York?
Yeah, it waves. During the pandemic,
Waves.
it was
Nice.
a problem, and
done.
Anyway, moving on. I do want to just say this. I was looking at synonyms for the word firming because I wonder if that's what the Federal Reserve did. Is they basically were like, okay, crystallize, amalgamate, coagulate. Like, how do you sort of signal?
They sit there and do that.
You think so?
Yeah, I'm told. They do.
On the Bloomberg?
No, I'm told.
Really?
Not on the Bloomberg. They have a Bloomberg.
But you think that they actually
They go
look up
through words.
synonyms?
Oh, totally. Totally. Sit around the table, work it
Congeal?
out. Yeah, spend ages doing this.
We're gonna
Talk
have...
to Clara about it.
That's really
Yeah,
cool.
no, spend ages.
I would enjoy that. Gel?
Gel. Is that another word?
Yeah.
Okay, cool.
yeah.
This is a good show. It's really good.
We're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions?
If we didn't have this banking crisis, then this would have been a more hawkish result.
How much will depend on how successful they are at ring fencing and limiting spread from the current situation.
The Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is.
The risk of a hard landing is higher now because the Fed isn't going to really know what's the appropriate policy to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I texted Tom yesterday, said dovish hike, lost it, went nuts. I'm so pleased he's not here because he'd be going insane as we talk about this.
That's exactly what they just did. It's a dovish hike.
It's a dovish hike, 25 basis points. Enjoy the beach, Tom. From New York City this morning. Good morning, good morning. Equity futures right now positive 0.4%. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK out all week. He's going to be back on Monday. Lisa, it was a dovish hike. It was 25, and quite clearly, I think they were pretty clear about the whole thing, that they believe the financial instability is a substitute for further tightening.
Facts have changed, and so did their expectations in terms of their rate path. At least that was how the market interpreted it. And I do think that while they did push back against rate cuts, it seemed like the balance of risks shifted downward. Basically, the chance of a hard landing seemed more clear in terms of what was happening with the banks, and rate cuts are now priced into the market pretty solidly.
Neil Dusser, Renmark, asking the right question, I think. There's not much time between now and the May meeting. It's early May, first couple of days of the month. Is that enough time to get enough incoming information to make a decision either way about hiking interest rates or not? I think you wait and see, don't you? Which is why some people think maybe a pause in May, regardless of how this plays out through the rest of this year.
Yeah, I'm not willing to even go that far, because ultimately, if we don't see any banks collapse and if we see some sort of stability, let's say we get deposit insurance. Let's say today Janet Yellen goes to the House and says, you know what, we're going to insure all deposits to up to $4 million and, game on. Do they then go back and say, okay, well, our preeminent concern still now is inflation at a time where the banking system seems pretty safe and sound?
You'll be talking about no landing again.
Exactly.
And keep going back to it. It's only been 2 weeks. But their base case has changed. The difficulty for investors right now, I think Jeff Rosenberg yesterday put it really well, where he was talking about the asymmetry of risks and how the tail risks are getting so much wider, where you could end up getting either much higher inflation on the back end, or you could get a hard landing and rates going to 1% or 2%. So either way, you could have a very different picture and a very different investing thesis. Jeff was right to point that out, and I think the phrase was something like, the risk cuts both ways. And the risk truly does cut both ways, which is why I thought it was pretty hard for the Fed to make what might be the right or wrong call. 25 basis points, wait and see is the right call. Wait and see how this plays out, because both of us have got no idea how this plays out in the next couple of weeks.
I do just keep going back to Janet Yellen, though, and what she was talking about in front of the Senate committee that she was speaking to, about how we haven't even considered insuring all deposits, which seemed to run counter everything everyone was saying at the same time that Jay Powell was saying the banking system is safe and your deposits are safe. So how do they square that at a time when people are depending on some sort of resolution there as one of the linchpins for the economy to have a soft landing or just cool more gradually?
So I'll make this point repeatedly through the morning, so forgive me if you've heard it before. I'll make 2 points. One, I don't think she contradicted herself from earlier in the week. I really don't. I think there's a massive difference between saying if a bank poses systemic risk and there could be contagion, then we will use the systemic risk exception to make all depositors whole. That's 1 point. There's a big difference between that and then saying we're going to have blanket deposit insurance. Massive difference. You can drive a truck through those two things. There's no nuance there. That's a huge, huge difference. What surprised me yesterday about Yellen's comments, it's not that she somehow contradicted herself from the day before. It's just the idea that they hadn't even discussed it. That's what I don't understand. Are you telling me after 2 weeks of this, after seeing deposits flee, banks in trouble, that the Treasury, they hadn't even had a discussion about blanket deposit insurance? Are we serious?
This does seem to be a little misstep or oversight. There is also, though, this question of how do they push back against a market that has gained some solace from the idea of deposit insurance in a broader sense to solve the problem, because right now people are saying a Band-Aid with just sort of swooping in and miraculously saving any bank that runs into issues isn't going to solve the problem over the long term at a time when there is a just completely different backdrop for the speed of which deposits can leave a bank.
We've got a lot to work through. In about 55 minutes, you're going to have a Bank of England rate decision, looking for a hike there as well of 25 basis points. They're very focused on the incoming information too, like everyone else. CPI early this week in the UK, north of 10%. Lisa will go through the day ahead in just a moment. I'll whip through the price action. We are positive by about 0.5% on the S&P 500. In the bond market, big rally into the front end yesterday. Yields lower by 20 basis points, even after that rate hike. Given that the median dot for 2023, the projections of the Fed remain basically the same when it came to the dot plot. For this year, at least, a lot to talk about elsewhere. Your 10-year higher this morning by 5 basis points, 348, Lisa, 348.84.
You mentioned that the Bank of England is having a press conference today. The rate decision comes out at 8 a.m. We're going to be hearing from the Bank of England's Catherine Mann. She's speaking at 11 a.m. And I'm curious about this divergence. We've been talking about it all morning, and we will continue doing it. Are we seeing a material shift from the U.S. more on hold and other European nations in particular, continuing with some rate hikes and more uncertainty as to the path ahead with an eye toward perhaps further hiking? 10 a.m. TikTok CEO Shu Chu is testifying before the House Energy and Commerce Committee. Very interesting to see whether we get some indication of the willingness of Congress members to potentially ban TikTok, force a sale, do something to insulate some of the data concerns that people have raised. And at 3 p.m., we get a Janet Yellen redux. She is heading back to testify in front of the House Appropriations Committee. Does she clarify her comments? Does she give some sense of what the discussions have been, where she and Jay Powell are on the same page, what the indications are for how they are going to solve a problem that has caused the KBW Bank Index to absolutely crater over the past couple of months?
She can say deposits are safe. She can say that. She can say she thinks they are. She thinks the financial system is resilient. It's basically what the chairman said yesterday in the Fed news conference. The one we all want to know is whether they'll drive forward with blanket deposit insurance. On which she's asked about the policy, she can't square the circle. That's the spotlight right now. That's the point of tension for this Treasury Secretary. Got some information for you, some breaking news that comes from Ford, the motor company, predicting losses in its electric vehicle business will grow to $3 billion this year. Let's frame the $3 billion this year. The deficit would match its accumulated EV losses over the past 2 years. This story coming out just moments ago. Lisa, the transition to EV, expensive, really expensive, and Ford's putting a number on it this morning. Especially because at this point, people are still buying trucks that are fueled by gasoline. And so how do you end up switching to a more modern technology or something that's the future when you don't have the clientele yet to back it up? And the transition costs are expensive. I think the order book for some of these vehicles, though, pretty big, isn't it? I would agree, but the costs incurred by outfitting your whole factory is difficult. It's a big thing. It's not an overnight thing. You saw the struggles that Tesla had, and they didn't have that legacy business to transition from. This is really difficult stuff. So that's the latest from Ford, predicting losses in its EV unit, the business to grow to $3 billion this year, the deficit matching its accumulated EV losses over the past 2 years. Joining us now is Jose Rasco, the CIO at HSBC Private Banking and Wealth Management in the Americas. Jose, let's start here. I've asked this question a few times. Is the Fed done from what you've heard yesterday? Because this market is screaming, you are so done.
You know, we don't think they are. I mean, if you look at what the Fed has said, they said they want to keep going, and we're going to keep to those words. We think they're going to go in May and June and get us to 550. And then we think they're going to be on hold for a while. Our economist has them on hold for the better part of a year. Now, that's going to come under fire, obviously, because, you know, the economy is going to weaken, and we're going to see what happens with the fragility of the banking system. That could change that course of action.
How much confidence, Jose, do you have in that view, given the fact that right now that goes completely against where the market is?
Yeah, well, we've got them cutting rates, but not till next year, right? So that's the problem. I think, Lisa, you raised a key point there. The Fed's trying to walk a fine line here, right? They're trying to tighten on the one hand and tighten conditions are tightening in terms of financial conditions. But on the other side, they're trying to provide the liquidity that the banking system needs. And liquidity seems to be the key word. So it is a fine line they're walking. And I think, you know, the market has anticipated a lot of rate cuts this year. But our economist still thinks it's off in the future. Yeah.
Is the investing proposal pretty much the same, regardless of whether there is a banking stress that causes the Fed to cut rates, or if the Fed doesn't see that kind of distress and continues with rate hikes and then holds for a year? Is it the same kind of outcome when it comes to where you want to put your money?
No, not at all. And I think, the first thing we have to get our arms around is what happens in the banking system in the short term. You talked before you put me on here, talking about regional banks and what's going to happen there. And a good deal of money has left, right? And as a result, they're going to have to do something to attract that capital back. And therefore, we're looking for downward revisions to earnings in technology because of the obvious situation with SVB and the banking system and financials. So we're looking for more downward revisions to earnings there.
Well, Jose, given everything that's happened, and I've got to put you on the spot, you've got to put money to work, are these regionals investable without blanket deposit insurance at the moment?
That's a great question. I think what they've said implicitly by not saying, and I've heard the argument, is that they will insure banks that are in trouble. And I don't think that's going to work. You're going to have to step up to the plate and either make a commitment or not make a commitment. And what they seem to be doing is piecemeal. And therefore, the market may push their hands and may force them to the table to make a commitment one way or another.
So is that yes, they are uninvestable for now, Jose?
Well, no, right. I mean, we're selective, put it that way. I think right now, we're telling most clients that, stay away from the regional banks now because we think there's more downside. But yes, we think there is some room in the future. But for now, we're very selective.
Interesting. Jose, thanks for that. Jose Rasco there of HSBC. Lisa, difficult moment, isn't it?
Especially
to make that call into those banks.
We're not getting any certainty on policy. None.
Zero.
And so how do you even begin to come up with a base case of profitability if you don't know what the parameters are?
What are the parameters? What are the parameters right now? How wide is the band of outcomes right now for 2023?
It's about as wide as you could possibly get. You could either get some sort of deposit backstop that gives a real boost to these banks, and all of a sudden they become the profit engines that they once were, or you could end up with more regulation and concerns about deposit flight. So then what do you do with that?
Alessio DeLongis is going to join us shortly. He came into the year constructive on risk assets. Then he got into the month of March and he became less constructive on risk assets. We'll talk to him about that. Alessio DeLongis of Invesco coming up very shortly. Equities up 0.5%, yields up too by 6 basis points, just short of 350 on a US 10-year in America, 349.41. A Bank of England rate decision about 50 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Fed Chair Jerome Powell has made it clear that inflation is still the top concern of the central bank. Less than 2 weeks after the second biggest bank failure in U.S. history, Powell advised that more Fed tightening may be in store following Wednesday's quarter-point rate hike. Officials are betting that the bank turmoil won't turn into a broader financial meltdown. The Bank of England is likely to continue the quickest set of interest rate increases in 3 decades. Investors and economists expect the BOE to raise the benchmark lending rate by 1/4 point. Those expectations were solidified on Wednesday when new data showed inflation climbing in the UK for the first time in 4 months. Treasury Secretary Janet Yellen says the U.S. is not considering blanket bank deposit insurance without working with Congress. A Senate subcommittee had asked Yellen whether protections for all U.S. deposits would require congressional approval. She also said that the heads of recently failed American banks should be held accountable. The U.S. fears that a war-weary world may embrace China's Ukraine peace plan. This week, Xi Jinping and Vladimir Putin discussed the proposals, which the U.S. has rejected. Still, dismissing it outright could let China argue to the nations tired of the war that the U.S. isn't interested in peace. And Ford's transition to electric vehicles isn't cheap. The automaker predicts losses in its EV business will grow to $3 billion in 2023 as it spends big on new models and factories. That matches its accumulated EV losses over the last 2 years. Ford has now started reporting financial results by business unit rather than by region. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
They are happy to export something here that 150 million Americans are consuming 3 weeks a year, on a platform that's run by the CCP that may serve their interests in hoovering up data from the American people. I think the American people have the imagination, if we chose to choose a different platform, and I think that's what we should do.
That was Senator Michael Bennet of Colorado on Balance of Power on Wednesday, talking about TikTok. The CEO of TikTok looking to defend the company on Capitol Hill later today, saying in prepared remarks the following: TikTok has never shared or received a request to share US user data with the Chinese government, nor would TikTok honour such a request if one were ever made. Lisa, is that sufficient?
No, because right now there is a narrative in the market, and that's what's going to be perpetuated by a lot of the politicians who are going to be speaking with the TikTok executive. What I think is wonderful about covering markets is it gets to the nuts and bolts of who benefits for when they do sell this immediately. It goes to, okay, well then on the other side, what happens if they sell these assets? Snap shares up almost 2.5% in pre-market trading just on cue ahead of this hearing.
And they've been flying.
They've been flying.
This is what Snap wants, it's what Facebook wants, because they can't get exposure to the Chinese mainland. And their view is, look, it's not just about TikTok and whatever you think about TikTok, it's about reciprocity as well. Surely that's the belief of these US social media companies.
I'm sure that belief is also informed by the fact that TikTok has the eyeballs of more than 3/4 of all teenagers in the United States.
Amazing numbers,
shocking numbers. So if they could take over that business, then ka-ching, right? So this is really the underpinning of some of the lobbying efforts that are behind the scenes with this particular hearing.
Always the way. Anne-Marie joins us now down from Washington, D.C. AMH, how tense do you think this hearing's going to be?
It's going to be incredibly tense, and it's going to be hours long. These lawmakers have been preparing on what and how they're going to tackle their questioning to the CEO, Xu Chu. And it's going to come from everything in cybersecurity, national security, as well as to mental health. And you do have some lawmakers who are going to point to suicides that have happened with young teens, saying that they got these ideas circulating on TikTok. So there's going to be a range of issues at play here. And really, he's going to have no allies in the room. This is a lose-lose hearing for this CEO. What he has been doing is try to fight some of this before he goes into that room and gets grilled by lawmakers. He came out with his own TikTok and said, if you want to make sure you can keep this app for all your content, there's 1.5 million Americans that are on it, put your appeals in the comments and also call your elected officials. And what you're seeing in Congress over the past 24 hours is actually the youth in the rotundas creating TikTok videos. They're there in support of the CEO.
How do you prepare, John, for a lose-lose hearing? If you know you're heading into the firing squad where everyone's just going to hate you, how do you prepare for that?
Look, if it's about security and national security, that's it. Bottom line, it's over. It should be conversation over. Shouldn't be about pleasing a certain part of the electorate because they use an app that you might ban.
Well, and this raises a question, and Anne-Marie, weigh in on this. Why haven't they banned this if CFIUS even recommended either a sale or some sort of ban?
Okay, so this has been through CFIUS prior to the Biden administration as well. During the Trump administration, Trump had an executive order that wanted to outright ban the app, but it got struck down in the courts. There's been a slew of legal challenges on that executive order. Then the Biden administration comes in, they had to redo that executive order, set up CFIUS again. That is why you have this issue we have today. It really got hobbled up in the court structure. Congress is the one that needs to move and give the authority to the executive branch to make a move on TikTok. Right now, I know you guys will be speaking to Senator Mark Warner in the next hour. It's his bill in the Senate that has the White House backing. That will give the Commerce Department to look into items like TikTok, not just TikTok. They want to give it broad support. What is interesting about this will obviously take months. They need to make sure the House gets on board as well to then send it to the president. And then once it goes to Commerce, then Commerce needs to do their review. This is going to come very close to the 2024 presidential election when Democrats certainly need those young eyeballs on TikTok. That's where they get their news, and these individuals lean liberal, and likely would be voting for a Democratic president.
That's where I was going to go, Anne-Marie. I've been making light of the fact that this is sort of the footloose of the modern generation, that basically people, teens and other young people who are on TikTok are saying, let me do my dances, let me get my news this way. What's the problem? Is that really the main pushback to why this hasn't really been a more actionable item yet?
That's one, I think, pushback that everyone is well aware of, that this would annoy the youth of their constituents. Senator Bennett said he's not on TikTok, but, you know, don't tell my kids I'm not, because all these individuals either have kids, no kids, and this is where they spend their time. This is how they socialize. But I think that's only one part of it. Obviously, they want to wait for the full CFIUS review. We've had reporting last week that that's pretty much hit a wall, with CFIUS recommending you either have to divest, sell. This can no longer be as is status quo in the United States. So I think now you're going to really start to see this momentum pick up after we've seen the CFIUS review really hit a wall. TikTok thought they can get around it with Project Texas. They say that Project Texas is unprecedented, but I spoke to a source that said unprecedented doesn't mean it's sufficient when it comes to user data.
MH, great work as always. Looking forward to your coverage later. Anne-Marie down in Washington. You can catch Anne-Marie and Joe Matthew on Balance of Power on Bloomberg TV and on Bloomberg Radio. You can see this weekdays at 5 p.m. Eastern Time. Balance of Power coming up a little bit later. Lisa, looking forward to their coverage, and I'm looking forward to this hearing as well. This is one of those hearings, and I think most hearings are this way, where they've already made up their mind about the outcome of this hearing. This is just kind of like entertaining the other person on the other side of the room. And we'll catch up with one of the senators leading this effort in the next hour, and we'll ask him just about that.
I want to hear how much is about national security and how much is about, you know, the mental health of individuals and things of that nature, because that's got to get Snap and
Well, if it's mental health, it's all of them, right?
A little nervous. I mean, that's not just a, you know, victory for them, and you've seen that victory in their shares, but you start to put restrictions on some of the big social media companies. You start going after some of these other issues. They're pretty broad-based. This is not just isolated to TikTok.
We mentioned this earlier. This is a hangover from the previous administration. What was the deal? Oracle and Microsoft, it was some random tie-up where TikTok was going to have a sale force through, and here we are years later talking about the same thing. Now, what's this bill about today? Handing off authority to the administration to make the ultimate call. Where's the administration on all of this?
The administration has come out, I believe, and said that they backed some sort of action on this particular company, and either a sale or a ban. How it looks, what their actions are going to be, whether they're open to it, the nuances. I'm sure you can drive a truck to it, just through, like
sure.
Janet Yellen and her comments about bank deposits. But, you know, will they? Especially ahead of the election. And I think that Anne-Marie framed that well. If we're bumping up against the election and you have young eyeballs on a site that gets, you know, lots of advertising from said politicians, are you going to really ban it at that moment?
That's a double-edged sword. And this is the problem the CEO's got today. When he comes out and says, we're on 150 million phones, you've got to think that through a little bit more. I mean, on the one hand, that says people like our product. On the other hand, we've got access to 150 million phones. That's not what this hearing wants to hear.
Correct. But then they think, but you're on 150 million phones. I mean, this is sort of the conundrum of politicians, because that's access, right? And this is sort of
it shouldn't be a conundrum.
How do you really feel?
It shouldn't be.
Well,
it's not for me to say it's a national security risk. They've got to make their mind up about that. I'm just here saying, if it is a national security risk, it's proven to be a national security risk. The rest of this shouldn't even matter, should be done. Forget about it. But the fact we're even entertaining this conversation that the youth won't come out and vote if you ban TikTok, we're meant to accept that something might be a national security risk, but because those individuals might go out and vote in the next election, we should just allow that?
Well, how much? I'll take that a little bit broader. How much is that really an argument about social media in a broader sense, with a lot of social media having a lot of the ills that Anne-Marie was talking about and proven out to be, and yet it's access. So advertisers, politicians, everyone loves it.
Sure.
So how much has this been the double-edged sword more broadly that has ended a lot of very important conversations that people have had?
Like we've said, it's been going on for a long time now. Yes, it's not a new conversation. Winnie Caesar's going to join us shortly. Looking forward to that. And we'll catch up with an interview Francine Lacqua has done with the SNB president. Really important stuff coming up shortly. 2 hours away from the opening bell, equity futures look like this on the S&P 500, positive by about 0.5%. 30 minutes from now, you get a Bank of England rate decision. We'll break that down with the team over in London. A little bit earlier this morning, we had a great interview with the Swiss National Bank President, Thomas Jordan. They've hiked interest rates. Bit of a messy time over in Switzerland. Take a listen to what the Swiss National Bank President, Thomas Jordan, had to say a little bit earlier this morning.
Basically, the Fed is saying that, one, uncertainty has gone up a lot. We're not really sure how long the banking system stress is going to last and how severe it's going to be. Number two, that stress is going to restrain the economy, and that substitutes a little bit for rate hikes. So we're not going to have to do as much as we thought we were going to have to do earlier.
That is not the right tape. I'm hoping we have the right tape now, so let's try again. The Swiss National Bank President, Thomas Jordan.
The Credit Suisse problem is much smaller given the fact that UBS will take over Credit Suisse. So this problem is solved, and this is good. So we have a stable banking system in Switzerland. Obviously, we have a certain uncertainty on the global scale. But I think we have to continue to follow that very closely, to observe it very closely, and then see what is the impact on the Swiss situation.
President Jordan, were you surprised by the turmoil that we saw in the markets given the wipeout of AT1s on Monday?
Well, I cannot really comment on the AT1 issue. This is our financial regulator who is in charge. There was some impact, but I see for the Swiss situation, it was limited.
But were you surprised by the market turmoil after the weekend in general?
Well, I cannot really comment on that. We are not in charge of the decision regarding the AT1s.
But of course, if there's market turmoil, it impacts what you're looking at and the parameters. Are you confident that we won't see a day like Monday again?
Well, we expect that now the situation will calm down, and also that people look at that very carefully, and it becomes more clearer what exactly are the medium to long-term consequences then.
What do you worry about the most right now? I know that a lot was done over the weekend, and you said, look, all of the other options, we would have been worse off. But going forward, what could be troublesome?
No, I think it's not absolutely essential that both banks, UBS and Credit Suisse, do everything that the takeover takes place in a smooth way, so that we do not have any risk anymore. So the commitment of both is complete. And it's very important that they work closely here together. This is important for their situation. It's important also for Switzerland. And we are supporting that by all necessary liquidity. And this is something where we look at very carefully, of course. On the global scale, the uncertainty remains high, and we look at that as well.
So I know you're briefed actually minute by minute, right, by what's going on probably with the two banks. What can you tell us about outflows from Credit Suisse? Is there a danger that actually the financial system in Switzerland has just become less secure, that depositors are wondering what happens also to this large bank?
Well, as you all know, last week was a critical situation, but now with all the measures that were taken and by the decision of UBS to take over Credit Suisse, I think this problem is now solved, and the situation is now much better.
Can you explain, President, what you think happened in the last 6 days? I mean, it all started in the U.S. with SVB. I know there were a number of also contacts, for example, with U.S. Treasury and U.S. regulators.
Yeah, of course, there were contacts. I think that it was a Swiss decision, and a decision that was also a private sector decision to do everything that avoids a resolution. Resolution would have been very problematic. It could have triggered a financial crisis in Switzerland with all the negative impact immediately here in Switzerland, but of course also globally. So it was very important that we could avoid resolution in those circumstances, given the fragility of the banking system globally and the financial markets. And that was achieved by having this takeover of Credit Suisse by UBS.
But what surprised you the most at the speed? And I know a lot of people are commending you at how fast this went. I mean, this was a fully capitalized bank.
Yeah, that's right. The bank was well capitalized at the beginning of the week, but then we had these shocks coming from the US. And at the end, we had in a very few days really a meltdown of the confidence of both counterparties and deposit holders that created this difficult situation. And fortunately, it was able, also due to good preparation, to have in a few days a solution that then avoided resolution under those circumstances.
Francine Lacqua joins us now from Zurich. Francine, once again, just phenomenal work. Once more, catching up with really important figures over in Switzerland. Francine, what did we learn this morning about the S&P and what they knew over the last week going into this takeover of UBS from Credit Suisse?
Well, what we learned is actually they're very conservative and don't want to say very much at all in terms of the market turmoil, certainly on Monday. I mean, we asked them multiple times, and of course, Thomas Jordan, president of the S&P, also fielded many questions at press conference saying, did you think that wiping out the AT1s would lead to such market turmoil? Like, remember, market turmoil is also in their remit, but he would absolutely not be drawn on that, saying, well, financial regulation, so the decision, AT1 and everything that ensues is actually FINMA, the regulator. What we also learned is that there doesn't seem to be a clear picture. Now, remember, we are only 4 days since that government broker deal between UBS and Credit Suisse, but there's no real picture about what happens next. He was asked also, and we tried to get more information on actually whether this changes supervisory roles, whether this leads to more rules. We also asked, of course, about what Jane Fraser said. Was there a bank run because we're much more on our mobile phones? And he said, look, he doesn't think this is the case at the moment. So this was a Swiss National Bank that was prepared for all questions, but prepared by just not answering them. It's still very soon to understand what the legacy of this cobbled together merger is and actually what kind of big, large bank Switzerland ends up with.
Francine, how much pushback is there within Switzerland, the move of regulators to allow AT1s, to allow these contingent convertible bonds to get wiped out before equity? How much investigation is there as to how that decision got made at a time where people are threatening lawsuits and they're seeing a huge divergence open up in pricing with the Swiss market and the European market?
So, Lisa, good morning. We actually heard from one of the parties looking into this, but I think it's going to be pressure really from outside. And of course, if you wipe out $17 billion worth of AT1s, they're going to be holders of that. So we're hearing about lawsuits. I thought it was very interesting. Remember, we were at that press conference on Sunday when we asked about AT1s. And at the moment, we hadn't had a clear picture of why that happened. It was only 4 days after this morning that FINMA, the regulator, so not the Swiss National Bank, put out this statement really explaining why they did that. But we had about 100 banknotes from various banks, from various analysts explaining why. So they're basically basing themselves on a law and a footnote in the prospectus saying this was the right way to do this. We also know from insiders that this was the big debate on Sunday. Like, if you do this, what does it mean for financial turmoil? So I don't know if the debate is really going to unfold in Switzerland or it's going to be those bondholders that we're trying to get to the bottom of exactly who held what that will try and do lawsuits. So it'll be Switzerland against these international bondholders.
Francine, wonderful work once more. Francine Lacqua out of Zurich. Francine, thank you. For those of you that would like to watch that interview in its entirety, you can find it on the Bloomberg terminal and shortly, I'm sure, on Bloomberg.com. Joining us now is Winnie Caesar, Global Head of Credit Strategy over at Credit Sites. Winnie, you came into this month with a different approach. You were tactically cautious and now you become more constructive over the last couple of weeks. Winnie, walk me through just the evolution of your thinking just over the last couple of months.
Good morning, Jonathan. Thanks for having me. So you're exactly right. We started the year very constructive on credit, and spreads hit our base case forecast for both U.S. investment grade and high yield by the end of January. And we thought, well, this feels a little overdone. And heading into that week of central bank meetings at the beginning of February, we were a little bit concerned about hawkish messaging and what could happen in the Treasury market. And that really unfolded. And then we had the banks issues. And we also went into this round of volatility fairly cautious on the regional banks. Our financials teams have had a really great call. And as of last Friday, we felt like perhaps things are a little bit overdone. Spreads had really blown out, yields had tanked, and we thought it's time to take that tactical caution off and go back to a full overweight in U.S. credit.
This is fascinating at a time when a lot of people say it's so hard to get any visibility given some necessary regulatory changes, whether it's deposit insurance or whether it's greater regulation on some of the smaller banks. How do you determine from a credit vantage point what's investable, what kind of uncertainty you're willing to accept?
This is a really tricky one. And I think that as we're thinking about the Fed and monetary policy and implications for the broader economy, banks are really where the rubber meets the road in terms of taking financial policy and pushing it into the real economy. So we think a lot of this is going to be a disinflationary type event, which is good. That's what the Fed has been trying to go for. The big question is how much of that momentum really impacts consumer spending, makes it its way into the labor market. And we don't think that there is a material risk of broad-based challenges. Instead, we've been calling for this bumpy landing. We don't ascribe to a soft landing or the no landing. Instead, some segments of the economy are going to feel some real pain, but we think that there's some pretty good visibility into the corporate credit markets where fundamentals are quite strong and have the ability to withstand some of those headwinds.
How do you push back then against some who look at credit spreads? I'm looking at high yield bond spreads around 500 basis points, 5 percentage points, and say typically during a recession or heading into one, you see 700 or 800 basis points in terms of credit spreads. This time is no different. How do you push back against that?
So I think that the big pushback is first, all-in yields are a lot more attractive now than they have been for, the past decade plus. We also have a fundamentally different high-yield market. We have more double Bs. We have more fallen angels that are now rising star contenders again. We also have a much better tranche of kind of liability management that has come through where maturities have been really pushed out. And also we have a leveraged loan market that's absorbed a lot of the more kind of stressed or highly leveraged capital structures that have gone to LBOs. So when you look at the high yield bond market, we can expect to see continued rates volatility, some spread volatility, but from a fundamental perspective, it is a much cleaner market than it has been historically.
Hey, Winnie, it's wonderful to hear your thoughts, as always. Winnie Caesar there of Credit Sites. Timed this perfectly, just perfectly, after January becoming cautious, then literally waiting for this to play out in the way it has done. Obviously didn't see it playing out precisely this way, but thought things had got too tight, and now sees things in a more constructive light.
If you liked it before the sell-off, why not
really
like it
now.
afterwards?
I totally get it.
Right, and so that's, one theory out there. However, as we've been talking about all morning, have the facts changed? And at what point do you have suddenly different parameters? And how do you get your head around what those would be?
USIG. There was a lot that was IG, which is now junk, right?
But that's my point, right? So all of a sudden, the downgrade risk becomes more tangible, at least in certain sectors of the economy.
Do you know what Danny Blanchflower thinks about the whole situation?
Cut rates to zero.
Danny's going to join us shortly. He's got things to say. So we want to give him the opportunity to say those things.
Absolutely.
Danny on the Bank of England. The Bank of England rate decision is about, let's call it 18 minutes away from the BOE. We're looking for a rate hike from Governor Bailey.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Worries over inflation trumped the recent banking turmoil as Fed Chair Jerome Powell rejected the idea of rate cuts and said that more tightening could be ahead. Wednesday's quarter-point rate hike comes less than 2 weeks after the second biggest bank failure in U.S. history. The Swiss National Bank raised its interest rate by 50 basis points and indicated that there's more to come. The SNB signaled that inflation outweighs any concerns after the market reaction to the downfall of Credit Suisse. Meanwhile, SNB Chairman Thomas Jordan says that Swiss banks are not exposed to U.S. bank failures. Citigroup CEO Jane Fraser says the string of bank failures has been isolated and that the biggest U.S. banks are well capitalized. Still, there's concern about smaller banks. Fraser spoke with David Rubenstein at an Economic Club of Washington event.
There could well be some smaller institutions that have similar issues in terms of they've been caught without managing the balance sheets as ably as others have done. And it's quite likely there may be a few of them. We certainly hope there'll be fewer rather than more, but again, it should be manageable.
You can watch the entire interview with Citigroup's Jane Fraser March 29th on The David Rubenstein Show, peer-to-peer conversations at 9 p.m. New York time. That's right here on Bloomberg TV. And there's a late twist to the sale of world-famous football club Manchester United. Bloomberg's learned that bidders have been granted extra time to come up with new offers. A Qatari consortium has already raised its offer above its initial $5.5 billion bid. British billionaire Jim Ratcliffe's first bid was below that, but he's also expected to increase his offer. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
If we need to raise rates higher, we will. I think for now, though, we as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is.
Chairman Powell of the Federal Reserve. A lot of people think he did a decent job in yesterday's news conference. Stocks were lower, but not because of the Fed chairman, because of the Treasury Secretary. In a hearing at the same time, we'll get into that scheduling another time, at the same time saying that all deposits being guaranteed and insured wasn't even part of a discussion, a conversation.
He can't win, really, can he?
No, he
came
can't.
out and he did a great job, by all accounts, to basically be as dry as possible and not say anything new and not go off script. And then Janet Yellen goes, yeah, about that whole deposit thing, whatever you thought, it's not really the truth.
He was never going to win. Yeah. We said it going into it.
He wasn't going to win.
Like, there was no winning. There's no good decision. After yesterday, after the last few weeks. I'm sure Danny shares that view. Danny Blanchflower joins us now, the Dartmouth professor and former member of the Bank of England Monetary Policy Committee. Danny, the Bank of England, inflation year over year, double digits, people looking for a rate hike. Do you think that's the wrong move today?
Well, I do, as you might imagine.
Well, I guess.
There was some news yesterday, which was inflation rose more than folks think, but that's gone, that's past. We're supposed to be focusing on what's coming. There's a major credit crunch, and the reality is that the Bank of England, in its forecasts, is forecasting no growth whatsoever for 3 years, inflation below the target, and we've just had a huge fiscal tightening. So basically, I assume they're going to raise. Everyone thinks they will, and what we're going to sit and watch here is disaster coming. Feels like 2008 all over again. Who's holding what bad stuff? Presumably in the UK, with the mortgage markets now in disarray, we're going to start to see banks holding bad mortgages, if you like, that people can't afford to pay. So I think this is the peak. This is a huge mistake. I would have been voting for big rate cuts. And what you'll see in the United States and the UK is disastrous data will show, and central banks will then move into panic mode, as the markets are pricing in already.
Danny, 25 is the wrong move. So let's talk about the Federal Reserve. Was that the wrong move yesterday?
Well, I think so too. I mean, we're seeing inflation now clearly has peaked. I mean, the question is, to what extent is this credit crunch a big deal? I mean, our pal Torsten Slot thinks that it's the equivalent of about 150 basis points of tightening. That's probably true. So this is a new set of tightening over where we were. The Fed has actually been entirely guessing. There is no economics to base their claims that this would be a soft landing. So you keep going and you keep going, but outcomes come about 18 months later. So the question is, what is there out there that we don't know? And you reported so well on Credit Suisse and the $9 billion that UBS had to receive to kind of make up for what's hidden under the hood that we didn't know. So at these times, you should be cautious as to what's coming on the downside. It's hard. I think the only question is, how bad is it going to be? So this looks like a wing and a prayer. We're going to carry on raising rates. Well, let's wait for some data to come. And my assumption is that it will start to come. I mean, the markets think it's going to come. I mean, Powell says, maybe we'll raise rates, but look at the Fed Watch tool. CME's Fed Watch tool says markets are pricing in 3 cuts by the end of the year. So why would you raise when the markets think you're going to cut? So we're in confusion. We're absolutely in confusion. And it really feels like 2008. In the UK, we rescued Northern Rock, thought that would solve everything. What happened was Bradford and Bingley, Alliance and Leicester failed, RBS failed, all about 6 to 9 months later. So watch this space. This was an error. Shouldn't have done it. There is no economic basis for anything that they're doing. And the real economy is what's going to matter. And wage growth is a big deal. That's not picked up in the way that they thought. Well, but really, the real economy is
Danny,
what we're going to do.
I have to cut in here because a lot of people are listening to what you're saying and saying, really, like 2008, banks aren't as leveraged at all. What you're dealing with is a liquidity crunch, not a credit crunch, at least not yet. And you're talking about assets that are backed by sound loans, not necessarily mortgage debt that was taken out by somebody with no income and who put nothing down. So this is a very different kind of scenario than it was in 2008. How do you push back against that and say that this is comparable?
Every credit crisis and every housing boom, for example, the standard thing that everybody says is this time's different for a variety of reasons. This time is different. It simply can't happen again. I mean, it's not just about that, Lisa. I think it's about confidence, remember. It's about confidence that the banks are whole. It's about confidence that my deposits are safe. And Janet Yellen, I think, made a huge error yesterday. I mean, her error was actually answering the question. So now we think, you have $1 million in some regional bank. What should you do? Well, obviously, you should pull that money out. If it's not guaranteed, then you should pull it out and take it to Bank of America. So that looks like an error, but it's about confidence, Lisa. And each time in the history of crises, everyone says this time is different. And I think the other thing is that, I mean, as I say, you guys have reported on it. What did UBS see under that hood that we don't know about? So I think that's a great deal of it. I mean, remember, as I say, in 2008, who would have thought in August 2008 that RBS would fail 2 months later? I think it's these kinds of surprises.
Let's put the banking...
I could be wrong, of course, but I think you have to be mindful that this is a giant credit crunch.
But let's put the banking crisis aside for 1 second, the known unknowns, the unknowns, whatever you want to call them, and just take a look at what the data was showing before this particular meeting, this sort of perhaps backward-looking but hotter than expected inflation data that was persisting in the U.S. as well as in the U.K. and other European nations. From your perspective, have you been surprised by how sticky inflation has been, how long it has taken to show signs of coming down? And does that get you concerned at all about where we're heading in terms of Fed policy being used as a tool for financial stability and fighting inflation?
To some extent, I've been surprised, obviously, because there are shocks. In the UK context, there's shocks imposed by Brexit. But again, go to August 2008. What you said was essentially what people said then in August 2008. Inflation was 5.5%. Within 9 months, it had gone to deflation. And what we're seeing in the United States is those base effects are dropping out. Certainly, if you look at the unseasonally adjusted inflation numbers, they're really very, very low. I mean, a lot of actually what you're seeing is about this weird technical thing about the seasonal adjusting. So really what we're talking about is inflation's high because of the way they've seasonally adjusted using new methods. So I think the answer is that look at the wages. Wages have not picked up in the way that people thought. Wage growth has been relatively benign. I mean, it's hard to read the data, Lisa. I mean, it's as if people think we have a nice playbook. We have never seen anything like this other than the Great Recession. Every piece of data since 1945 to today is utterly irrelevant. We have to look at other crises. And what you'll see is then suddenly inflation plummets. So I think that's what's coming.
Danny, I've got to squeeze this in. Just 60 seconds left. If they came out and offered blanket deposit insurance, would your view change?
Probably would, actually. I mean, I think in a sense, the answer then, John, is that wouldn't the Bank of England and the Bank of Canada and the ECB have to do the same? But I do think that the blanket deposit insurance would really be a help. Certainly think that.
Danny, thank you, sir, for catching up with us. Danny Blanchflower there of Dartmouth, going into the Bank of England decision 6 minutes away. Seems like that's a game changer. Even for someone like Danny, thinks that they should cut all the way back to, 3, 2, whatever it might be. Danny can speak for himself. That if you come out with that deposit insurance, it could change everything, which is why I think it's quite difficult for the Fed to make the right call. They've only got the last 2 weeks to go on. Do they extrapolate that out through the rest of the year and start cutting interest rates? Who's going to do that?
Well, and we don't understand what the banking system will look like if they don't provide deposit insurance. There doesn't seem to be the political will to do that, and that would really have to come from Congress. And that's part of the problem that I think Jenny Yellen was facing off with yesterday. The issue that I think Danny is raising, and rightly so, is that you're not solving the problem by just saying we're going to swoop in and save deposits or insure them in a systemic crisis. How do you know which banks are systemic? How do you know which banks are going to rise to the occasion for some sort of rescue? Can you count on that in the same kind of way as you can count on one of the biggest banks that will hold your deposits?
The Fed chair has given you the playbook now for monetary policy. Believes the situation is a substitute for rate hikes. To what extent, we don't know. The longer it continues, the worse it gets, the less they'll have to do, and the more we'll start thinking about them moving the other way and cutting interest rates.
Which is the reason why you see that priced into the market right now.
The question is, can you make that call today as a Fed chair?
I don't think you can. I don't think you can.
We can say in a couple of months' time, what an idiot for hiking interest rates.
We would. But either way, he will be somehow.
It's tough.
The whipping post here.
We're looking at what's happening among the banks, and asking, is there going to be some tightening in credit conditions?
If we didn't have this banking crisis, then this would have been a more hawkish result.
How much will depend on how successful they are at ring fencing and limiting spread from the current situation.
The Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is.
The risk of a hard landing is higher now because the Fed isn't going to really know what's the appropriate policy to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
And we've got another rate hike, this time from the Bank of England, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK back with us on Monday. As you all know by now, he's been away all week, missing the action. Cable right now, sterling stronger by 0.5%. The Bank of England raising interest rates from 4% to 4.25, up 25 basis points over on Threadneedle Street. And Lisa, just like the Federal Reserve and the ECB before them over the last week, you have to take a stance on monetary policy and then explain your thoughts about financial stability at the same time.
And basically, they said that they're in conversations with policymakers and do see stability in the banking system, which is pretty much as you would expect. But that really is one of the themes. What they did say was not only are they going to raise rates to 4.25%, but signs of inflation persistence would require more hikes. So not exactly taking hikes off the table going forward. It was a 7-2 decision. So I'm curious about those two dissents and what exactly they were looking for. And they were also looking forward to ongoing scrutiny of any more potential stress in the banking system, but calling it resilient. That same word that you hear from central bank to central bank.
And there's a very clear distinction between what's developing here in the United States compared to, say, the UK and Europe. There is a belief here in the United States that the financial instability of the last couple of weeks is going to lead to tighter financial conditions, tighter lending standards, and a belief on the committee at the Federal Reserve that that is a substitute for rate hikes, even up against inflation that's too high. In the UK and Europe, seemingly, Lisa, they haven't seen enough evidence in the UK or in the Eurozone to make the same argument.
Not only that, but they're actually increasing some of the projections for the economy and economic growth. So exactly that. It doesn't seem like this is the same kind of deterrent to rate hikes going forward in Europe as it is in the U.S., which raises this question of, are we seeing that ongoing divergence between U.S. and European policies at a time where there is a difference in terms of where the disinflationary process is?
4%, the previous rate. It's now 4.25 over at the Bank of England. Sterling a little bit stronger, 123, the pound against the US dollar, 123.08 right now. Over at the Bank of England, outside the central bank, is Bloomberg's Lizzie Burden. Lizzie, your thoughts on this one?
Well, it's the smallest hike since June, but it was what we were expecting, John. It takes the key rate to 4.25%, the highest level since 2008. That upside inflation surprise yesterday really nailed this on. Remember, the bank has had this data, we think, since Monday. But as you say, it follows the ECB, the Fed and the SNB. You might say that they're all prioritising the fight against inflation over financial stability. But really, the bank's always said that it's not bothered about short-term volatility. It's focused on the long game. And also, remember, a stable inflation environment contributes to financial stability. There's no press conference later, but it's interesting the vote split 7-2. We had expected a 6-3 split with John Cunliffe expected to join the Doves. He hasn't. It's just Silvana Tenreiro and Swati Dhingra. They've both expressed their concerns about previous jumbo hikes having yet to fully take hold because of the lag in monetary policy. Dhingra as well has said that she thinks domestically driven inflation is being overestimated. She's a trade expert. But looking at the future path for rates, they'd already removed the language about acting forcefully and downgraded it to the need for further tightening if necessary. And in terms of the inflation outlook, the bank says that inflation's now likely to fall sharply over the rest of the year, that the second quarter inflation forecast will be lower than was seen in February. So that's good news for the Prime Minister, Rishi Sunak. Of course, he's made cutting inflation his #1 priority.
So can we categorize this as a dovish hike, or is this basically a hike with a lot of uncertainty and question marks around it, and perhaps a bit more confidence in the financial system in the UK than in the US?
Well, I would read the fact that John Cunliffe hasn't joined the dissenters as showing his confidence in the financial system. Remember, he's in charge of financial stability. They have added guidance saying that they're closely monitoring credit conditions. So yes, there is an element of uncertainty, but over recent days, the Bank of England and the UK Treasury have been at pains to stress that they're confident in the financial system. So it's as expected, but they are showing their confidence in what we have here.
Lizzie, wonderful coverage throughout the whole of this morning. Lizzie Burden there, over on Threadneedle Street, or rather just on the other side in front of the Bank of England there. Lisa, your thoughts on this one? Clearly, across the ECB, the Federal Reserve and the Bank of England, there is one key similarity. They're all worried about the signal they send around the monetary policy decision. You heard it there in that report from Lizzie. There was maybe a little bit of reluctance to join some of the doves because you don't want to project that you're worried about the financial system at the same time as saying it's robust.
This just casts a muddy pall over everything that is already muddy. I mean, how do you look at inflation with any kind of clear lens if you're also worried about signaling at a time of all of this concern around a banking system that a lot of people are saying is resilient? Everyone has to say that. And at the same time, you are seeing concerns that percolate from one to another. It's like whack-a-mole. Who's going to see some concern next?
Joining us now is Alessio De Longa, Senior Portfolio Manager at Invesco. Alessio, you started the year constructive. You came into March less constructive. Alessio, talk to me about the change there, given what we've seen transpire in the last couple of weeks.
Lisa, John, thank you for having me. Yes, at the beginning of the year, we had a very constructive view, which panned out a little too fast and too far. So when we entered in March, many of our indicators started signaling a little bit of an extended price action and sentiment that was beginning to roll over as a result of renewed positive inflation surprises, bear steepening in yield curves, and the repricing of additional policy hikes. That led us to, from a cyclical perspective, to reposition again for a defensive asset allocation posture. What happened with the banking developments over the last couple of weeks has accelerated that path, has validated that path, but it's important to make a distinction. We have been able over the last couple of weeks to rule out, thanks to the policy actions and the developments in Switzerland, to rule out a systemic accident in the banking sector. With that being said, the tensions in the credit markets have increased. From a cyclical perspective, wider credit spreads, wider lending, more restrictive lending standards, and lower credit growth are necessary conditions to have monetary policy tighten in the future and bring inflation down.
Alessio, there seems to be a policy divergence driven by the fact that the U.S. financial system, and I'm talking not about the big banks, but the regionals that are subject to some of this deposit flight, that the banking system does have a more pervasive issue that needs to get dealt with than some other nations, including the UK and including Europe more broadly, continental Europe. Do you agree with that? Can you trade on that? Is there something underpinning that in terms of perhaps ongoing rate hikes in Europe and the end of them in the U.S.?
I think the cyclical divergence is there in growth and in monetary policy. On the margin, from this point on, I think with the Federal Reserve, we're looking at marginal increases, let's say another 25 basis points hike in May. But the ECB and potentially the Bank of England, I think, have more to go, at least another 50, if not more. That cyclical divergence can be expressed through multiple venues. Again, I'm ruling out I wouldn't say that we can trade on the more structural systemic aspects of potential bank regulation. I think what we should focus on is trading on that cyclical divergence, trading on the cyclicality of the price action, which I think has returned. The last couple of weeks were more of a risk of a systemic shock that would have changed that dynamic. But I think now we are more comfortably back into the typical end of a tightening cycle pricing dynamics.
So when can you go back into European banks?
European banks are not for now, in my mind. We favor a bias away from value and away from cyclicals, of which banks are one, more into quality-oriented, lower volatility and growth-oriented sectors. So defensive sectors such as healthcare, consumer staples, and even technology, which screens now on quality characteristics. And we have seen that quality pan out as soon as rates began to rally again. Those sectors and styles with longer dated cash flows and more duration have outperformed. We think this is an environment for defensive sectors.
Alessio, just quickly, just to wrap it up, are you working on the assumption now the Fed is done?
Working on the assumption that one more hike and then we are done. So cyclical divergence in favor of European equities, in favor of the euro, and a global backdrop where a policy being done is not necessarily the recipe for a rally just yet. We need to see the impact on growth first.
Interesting. Alessio, thank you. Alessio, the longest there of Invesco. What'd you make of that?
I like the idea of divergence. I'm just trying to wrap my head around what that means. Because if you do talk about a growth divergence, then shouldn't you see some of the more cyclical areas of the European market doing better than over in the U.S.? And you're not really seeing that in the same kind of way. So I don't really understand how to sort of square this circle from an investing perspective. This is an incredibly confusing market, basically.
It's too soon to draw conclusions after the last couple of weeks. I'm just going to keep repeating Dan Iverson at PIMCO, which is usually the safe thing to do based on his record over the last several decades.
And then ask me what I think.
Which is, it's a multi-month process. It's a multi-month process. It's too soon to talk about the ripples out from this.
How long do I have to deal with this? With you just
for
repeating over and over again? It's a multi-month process.
For a few more months, basically.
You're not wrong, and neither is Dan Iverson. The problem is that people have to make calls and changes.
No, I know. And then people on programs like this have to come up with something new every single day. I get that.
I know. And you feel...
But sometimes just make it boring and say it how it is. It's been 2 weeks. It's been 2 weeks. We've had 2 weekends where bankers have had to sit there and listen to regulators as their banks have basically shut down. 2 weekends of that. We've got no idea what next weekend looks like or the weekend after that.
This is true. People are clinging to what they do know, which is it does change the scenario to some degree in terms of credit standards and the lending, the willingness
it's the psychology in investing. You know this, Lisa. They're clinging to what they want to happen and using what has happened just to plug into their view that already existed. Everyone was already... everyone was there at the start of the year. They're going to cut. The Fed's done. Recession's coming.
Okay.
Now they've got a new reason to make the same call.
Yeah, but this one's right.
Yeah, well, maybe. Maybe. It's like I said, Danny's the biggest dove anywhere.
Yeah.
You turn around to Danny and you say, would your view change if we got blanket deposit insurance?
Yes, it would.
His view would change. Now, how quickly could that happen? I don't know, but is it possible?
It's a great
point.
Sure,
it's possible still.
It's a great point.
Futures right now on the S&P. On the S&P 500, we look something like this, positive 0.4%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. On Capitol Hill today, the CEO of TikTok faces a number of lawmakers who want the video game app banned in the U.S. The Republican chair of the House committee holding the hearing, Kathy McMorris Rodgers, will tell Show 2 that its popularity exposes a vulnerability that could be exploited by China. TikTok says it has spent $1.5 billion to address data security concerns. In New York, the grand jury considering charges against Donald Trump reportedly is expected to reconvene today. That's according to ABC News. The case involves alleged hush money payments to porn star Stormy Daniels and whether the former president concealed the payments. He's denied any wrongdoing. The U.S. fears that a war-weary world may embrace China's Ukraine peace plan. This week, Xi Jinping and Vladimir Putin discussed the proposals which the U.S. has rejected. Still, dismissing it outright could let China argue to the nations tired of the war that the U.S. isn't interested in peace. Apple's launching an ambitious effort to raise its profile in Hollywood and attract subscribers to its streaming service. Bloomberg's learned Apple will spend $1 billion a year to produce movies that will be released in theaters. The list of potential releases includes films from directors Martin Scorsese and Ridley Scott. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
They are happy to export something here that 150 million Americans are consuming 3 weeks a year, on a platform that's run by the CCP that may serve their interests in hoovering up data from the American people. I think the American people have the imagination, if we chose to choose a different platform, and I think that's what we should do.
That was Senator Michael Bennet there of Colorado on balance of power. just on Wednesday, talking about TikTok. The CEO of TikTok is looking to defend the company on Capitol Hill a little bit later today, saying in prepared remarks the following. TikTok has never shared or received a request to share US user data with the Chinese government. Nor would TikTok honour such a request if one were ever made. So he's going to sit in front of these senators, Lisa, he's going to say exactly that. And what do you think the senators are going to say back to him? Do you think that is going to convince them when they turn around? Or rather the House, the representatives of the House, is that going to convince them?
Well, it can't convince them because the empirical data would highlight that the Chinese Communist Party doesn't exactly take, we're not going to honor your request very well. So that wouldn't necessarily go over in the same kind of way as perhaps they would wish. This is really the question that I have. To what extent is the questioning going to entirely rest on national security and how to ring fence the data? And how much is it going to really focus on some of the other, perhaps, side effects of social media? And the reason why I think that's important is because how much does it really target other social media companies as well versus just isolate TikTok from a national security perspective?
We'll come back to this story in just a moment. If you are just tuning in, about 18 minutes ago, the Bank of England hiked interest rates by 25 basis points, a 25 basis point rate hike after the ECB went 50 last week and the Fed went 25 just yesterday. But just run you through the price action briefly. The equity market futures still doing okay at 0.4% on the S&P 500. Sterling was rallying off the back of the decision. And in the bond market at the moment, your two-year yield is higher by 3 basis points to about 3.96. Still get some economic data, Lisa, in about 12 minutes' time. We've barely talked about it. And I do think the news conference yesterday has changed the way we will receive that incoming information and that economic data for the Federal Reserve, because the Federal Reserve has basically told you that what dictated the outlook, to some extent, wasn't just inflation, it was financial stability.
So when does the data start to matter again? The economic data I'm talking about. And this is something that we've been talking about for a while, that we got hotter than expected inflation numbers for a while. So that at what point do you come in and say, OK, now we are looking at that again, and now we are looking at the potential for a resurgence in inflation?
Let's get to Anne-Marie. She's over in Washington, D.C., our chief Washington correspondent. AMH, this Thursday, today, in front of the US House Energy and Commerce Committee hearing, the CEO of TikTok will speak. What can he say today to allay some of these concerns?
So one thing that he's really going to want to highlight is this idea of this plan they have called Project Texas. It was a way to try to ring fence, isolate U.S. user data in the United States, use Oracle for this. But when you have reporting like I have last week that the U.S. government is telling ByteDance, you need to divest, sell these shares, or face a ban. Clearly, Project Texas was not sufficient by CFIUS in terms of protecting that user data, that they are now telling ByteDance that this is the option. You either need to sell or face a ban. So the CEO is going to try to do whatever he can to talk about this, what they call unprecedented action, how much money they spent on this, and how they really feel like this is secure, and also that he will likely mention that the Chinese Communist Party has never asked TikTok for any of this user data. The issue is most of these lawmakers are not going to buy it. It's become too long. This has been an issue for too many years, and they just don't see the reason why TikTok should be allowed in the United States, given the fact that it's owned by ByteDance, when even TikTok itself is not even allowed in China, and it's also banned in India.
Anne-Marie, to answer the question that John asked me earlier that I kind of punted on and basically gave a very messy response to, what is the next steps if Congress does sign off on some sort of bill? Is it just to shunt it over to President Biden and say, over to you, this is yours?
Well, so what would happen is it depends on which bill it is. There's 4 really standout TikTok bills that we are keeping our eye on. The one that has the White House backing is this one by Senators John Thune and Mark Warner. Now, this doesn't even mention TikTok in the bill. What it does do is it gives this broad support to the Commerce Department to really look into it. This was an executive order actually under the Trump administration. So it would basically mean that executive order stands. It would give the Commerce Department the needs that they can go through this, look to see if there's any national security issues with not just TikTok, but other companies coming from what they would call foreign adversaries. And then the Commerce Department would then make their suggestion. That would likely lead to a ban. But then again, what I said earlier is this could take months, right? We don't even have this bill on the floor yet. these are just ideas at the moment.
Anne-Marie, we're going to be following this throughout the morning. The hearings start at 10 a.m. I do want to pivot just slightly as we are talking about this issue, perhaps affecting a lot of teenagers. But the bigger issue for markets right now very much is deposit insurance. And I'm wondering what the latest is and what you expect to hear from Janet Yellen, whether there has to be some sort of cleanup act today, given some of the response in markets and the messiness of the communication, the divergence between her and Jay Powell.
Yeah, so yesterday everyone thought Federal Reserve Jay Powell was going to make all the news, but it was actually at a subcommittee for appropriations for the Treasury Secretary. First, we should give you some context. She was scheduled to go there to talk about the 2024 fiscal budget. You're going to see a number of Biden cabinet members up on the Hill this week. Today will be Pete Buttigieg talking about the transportation budget. We also had Secretary Blinken yesterday talking about the State Department's budget. But obviously, given what we've seen of the past 2 weeks in the banking sector, she was asked about this. Our reporting was that U.S. officials were temporarily looking at ways to expand the FDIC insurance. This is something that mid-sized banks were asking for. The question asked to the Treasury Secretary was about if Congress would have to have approval. So she was saying, and I think it's the use of the word blanket that is very key here. She's saying that we are not looking at a blanket use of this. So potentially our reporting about more temporary, an emergency response, she made clear in her statement they're not looking at a blanket case for this. That would likely need congressional approval. But she also made the case in this answer that the reason why they lifted that FDIC insurance cap is because they saw a risk of contagion. So she said if we see any sort of systemic risk that there could be a bigger run on banks, that's when we would have to go in and use this emergency power.
AMH, great work, as always. And a key distinction, I think this key distinction is really important. Secretary Yellen is in a really difficult spot right now in these hearings. It's a circle you can't square. It's just really, really hard to do. You can sit there and say, if a bank fails and it has the threat, poses the risk of contagion, we can use the systemic risk exception to make all depositors whole. That makes sense. She keeps repeating it. She can't sit there and say, yeah, we're about to do a blanket guarantee of deposits. She can't do that yet. She can't say it.
She doesn't have the authority to do that because that really does lie with Congress. And this is the problem. And at the same time, how does she give confidence to a system? I do wonder if people are going to start saying, well, how about more transparency? How about a greater sense of which banks are raising red flags to you in terms of the duration mismatch or how much they have to fulfill any potential deposit withdrawals or concentration in particular industries, right? I mean, what if they did something like that where they just made it clear to everybody so that they had a sense?
Lisa, I've got to run, and they've got a really important conversation coming up in the next hour. Kathy Jones of Charles Schwab, Sam Linton-Brown of BNP Paribas, Robert Tipp of PGIM Fixed Income, David Bianco of DWS as well. That's the lineup, Lisa, going into the opening bell.
Can't wait to hear some of the conversations and parsing through what to watch going forward. We have been talking about TikTok all morning. That is going to be dominating Capitol Hill. Mark Warner joining us, the senator from Virginia, who is leading up some of those hearings in front of the House, in front of the Senate committee, as we do expect a no-win situation right now for the chief executive officer of TikTok. Can you give us a sense of what you're hoping to get out of these hearings, Senator Warner?
Well, unfortunately, I'm not going to be in the hearing. It's actually a hearing today in the House. But I've had concerns for some time that the United States has not had any kind of rational policy about how we deal with foreign technologies from countries like China and Russia that pose a national security threat. A few years back, it was the Russian software company Kaspersky. Back in 2019, we went through a long debate about Huawei. Now we're talking about TikTok. So I put a bipartisan bill together that's been endorsed by the administration. I got 10 Democrats, 10 Republicans that said we ought to give the Secretary of Commerce the authorities and tools that could, if there is a national security threat, allow her to take actions up to and including divestiture and including banning. And why TikTok? Two reasons. One, TikTok is extraordinarily popular. Let me acknowledge that. 150 million Americans. Some of the data I've seen on average about 90 minutes a day. What TikTok's genius is it learns from you every time you're on. So it's getting and collecting data that is individually specific. At the end of the day, no matter what the TikTok CEO says, Chinese law made clear in 2017 that ByteDance, Chinese company that owns TikTok, at any point, the Chinese government can require that data be turned over to the government. I think that has the ability to harvest data that could be used. It's already been demonstrated to be used to spy on journalists. It could be used to target certain people in the Chinese diaspora. It can be, frankly, used to ultimately target some of our kids who are on that site on such a regular basis. So the data collection is number one. The number two part is this is a huge potential propaganda tool. Should President Xi decide that he wants to go ahead and take on an invasion of China, or I'm sorry, invasion of Taiwan, TikTok could be that site that is saying to literally hundreds of millions of folks all around the world, 150 million Americans, hey, that's not so bad in terms of the message that is conveyed. And evidence of that, in many ways, has been the Chinese leadership has said they would rather have TikTok banned in America than give up the source code, which is the secret sauce, the algorithms that create this wonderfully addictive tool. They would rather give up TikTok in America than give up the source code. And I don't know how Americans could ever be safe without that source code and getting out of China and into the United States.
Senator Warner, just before, because I want to make sure that we get this point clarified, just to dig into what you're saying a little bit more. You're talking about national security concern and how this data can be used to be manipulative to a broad swath of the public. But there's also this question, as you said, of learning from you and data collection. How do you draw the distinction between TikTok's use of this as being a company that's owned and headquartered in China versus social media companies in the U.S. that also collect data and also have a lot of learning tools from their users?
Great question. And candidly, I've got some concerns about the American companies. I think it's an embarrassment that we don't have a national privacy law. I think it's crazy. I'm a former telecom guy that we don't have an ability to have data portability and interoperability. So if you get tired of Facebook, you can move to a new site and basically still talk to your friends. I think it's crazy that we've not taken on what's called Section 230, which gives all these social media companies a get out of jail free card for any of the content that they post. We've not been able to move on it. But all of those concerns I have about American and British and Indian and other companies, those concerns are not national security based. They are, I think, basic fairness and business practices based. End of the day, TikTok, ByteDance, its Chinese parent, I believe has to be obligated by Chinese law, changed in 2017, made very clear that every Chinese company ultimately is not responsible to shareholders or customers. It is responsible to the government. And the fact that this can end up, this data or this potential content manipulation can end up in the hands of the Communist Party, that moves this platform into the realm, in my mind, of national security. And one of the things that my law would also do is require the intelligence community to declassify as much information as possible, so it's not just a case of, hey, trust us, that this is a security risk. And I do believe that should this action take place, that the market will create an alternative. All these folks who are making money off of TikTok, social influencers, I believe there will be other sites. There are already some, maybe not quite as attractive yet as TikTok, but there will be other sites. And that can be companies in America, in India, in France, you name it. I think the market will provide that alternative.
Senator Mark Warner, thank you so much for your comments. And we look forward to catching up with you after the House hearings and after this has developed even further. And as you talk about other opportunities, I should say, Snap shares up 3.4% in pre-market trading. We are getting some data on the jobless numbers, probably not what this Fed chair wants to see. Michael McKee, handing it over to you.
Unfortunately, for those who are looking for the labor market to weaken, it hasn't happened yet. According to the Department of Labor, 191,000 people filed for initial jobless claims last week. That is down from the prior week, and it is also not what was expected. There was a thought that it would go up to 197,000. But the problem here is that we are not seeing any kind of movement at all. There are a lot of layoff announcements out there, and we're waiting to see what happens and when those will start showing up. But Lisa, and it looks like at this point, what's going on is people are getting severances, so that keeps them from filing for jobless claims, or companies are just holding on to workers.
Mike, yesterday we were talking about how the actual economic data just doesn't matter anymore to the same degree because we are looking at the potential for some sort of systemic event in the banking sector. That's what people are worried about. So at what point does the economic data matter? At what point are we looking at jobless claims coming in lower than expected yet again as being perhaps a sign that we still have a hot labor market?
Well, I think we have to look at it as the Fed being on sort of two paths. One is they're keeping an eye out for what's going on in the banking system. And since they don't know what the effect is going to be, they're going to operate with the data that they have that show a tight labor market and show inflation still high. So they're going to make monetary policy on that basis. So they'll be looking at jobless claims. They'll be looking when we get to April at the March payrolls report. They'll want to see if average hourly earnings are still going up. And of course, we're going to have your new favorite economic indicator, the survey of senior loan officers by the Federal Reserve to see what credit tightening there is. They don't have an exact date for that, but it will come out in April. So we'll be watching for that and break into whatever programming is on when that comes out.
Michael McKee, thank you so much for keeping us posted. And we'll be breaking down all the data that people are no longer looking at from here on out until that senior loan officer credit survey comes in. I'm just kidding. People are still looking at this. If you're just joining now, initial jobless claims coming in lower than expected, 191,000 versus 197,000. Continuing claims coming in just a touch higher, but no drama. And this really is just pointing to the ongoing strength in a labor market that perhaps is backward looking enough for the Federal Reserve to move on. You're not seeing any drama with respect to market reactions. Two-year yields are 3.97%. And you can see that ongoing bit of recovery, bit of optimism in equities as people take a look at the potential perhaps for sooner rate cuts. Joining us now to really parse through the economic picture and when it will matter again, Stephen Stanley, Chief U.S. Economist of Santander U.S. Capital Markets. Stephen, I want to start there. Why doesn't the economic data matter?
Well, I think markets right now are focused on the possibility of further shoes to drop with this banking situation. So, you know, if something major were to happen there, that obviously would take precedent. I think a number of folks are worried that the events of the last couple of weeks are eventually going to create a significant economic weakness. I'm not so sure about that, but if you believe that, then it doesn't so much matter what the data looked like last month or even this month, because, you know, there may be something coming down the line.
You don't believe that, Stephen. I want to just build on that. So in other words, you think that what we have seen so far in certain regional banks doesn't necessarily tighten credit conditions enough to act as a rate hike or two rate hikes or whatever you want to price in down the line.
I mean, I do think there will be an impact. I mean, I think credit conditions are going to tighten, but I think it will be relatively modest, and it's moving in the direction that the Fed has been hoping to push toward for quite some time. I mean, the Fed has been trying to tighten financial conditions, and to be fair, they've really struggled to do so, I think, to the degree they would like. And as you mentioned before, they're having difficulty getting the economy slowed down. The labor market is still overheated. Inflation is still very high. And so a certain amount of credit tightening would, from the Fed's perspective, actually be a good thing. Now, obviously, too much of a good thing becomes problematic. And so they're hoping to kind of cut this off without further contagion. And that's what we're looking to see as we go forward.
Yesterday, as traders listened to Fed Chair Jay Powell with a split screen of Janet Yellen over testifying in Congress about perhaps not having full-scale deposit insurance for some of those smaller banks, they had one conclusion. This is the end of the rate hiking cycle, and the Fed's going to cut rates pretty significantly going forward. Do you disagree with that assessment?
I do. In some ways, what I've said is we've gotten back to the natural state of affairs, right? I mean, this is how we were. This is how we were aligned for most of the second half of last year and into the beginning of 2023, with the Fed talking about additional rate hikes and then being on hold for a long period of time, and the markets pricing a quick pivot. So we're back to that after a brief dalliance with the markets getting super hawkish. And so I think in some ways it's kind of a comfortable position, but again, it's really a function of a different economic outlook. The Fed sees the impacts of this as being limited. You could see it in their GDP forecast yesterday. The 2023 growth forecast was revised down by 1/10, and the 2024 forecast by 0.4. So that's kind of their preliminary assessment of the magnitude of the the effect of the events of the last couple of weeks. The markets are looking for something much bigger than that, I think, in terms of downward influence.
When are we going to see the economic data start to matter? I mean, I know that we began that at the outset, and people would say, well, when the banking issues have been resolved or we have some sense of the scope of them, is there a data point that we're looking for that will take on importance regardless of what the backdrop is in the banking sector?
Right. Well, I think that the headline economic indicators are still going to matter. So employment reports, CPI, maybe to an extent consumer spending, those are the ones that have really driven things in the past. And so a lot of the other second tier indicators that we watch, not that they're irrelevant, but they're just maybe not enough to kind of break through the heightened level of noise right now. I think the other point I would make is that as the banking situation hopefully calms down, the data will become more important, right? Because right now people are of the mind that we're looking at a totally different economic situation in 2, 3, 4 months' time, and it will take time for that to play out. But if indeed it's closer to what the Fed has suggested or what I'm suggesting, then the banking situation isn't necessarily going to dramatically change the trajectory of the economy, and therefore we get back to kind of business as usual in terms of watching the key indicators that have been driving Fed policy.
Stephen, before we let you go, what do you think the terminal Fed rate policy is going to be at this point, given the last couple of weeks?
Yeah, I haven't moved. I mean, I'm at 5 3/8. I would say it's either 5 1/8 or 5 3/8, depending on on how much this banking situation continues to be an issue, and how quickly that makes its way into the economy. But I would say, unless we see a miraculous fall in inflation, the big difference I would take with what's priced into the market is more in terms of this pivot idea. I just think the Fed is going to be on hold until inflation gets down to something much closer to 2%, and that's, I think, going to take a while.
Stephen Stanley of Santander U.S. Capital Markets, thank you so much for being with us. In other economic data, Shonali Basak here with the banking update. It does seem like this is the economic data point of the moment, which is bank stocks and how much fear there currently is in the system. I'm wondering, it's not just traditional banks. If you look more broadly, where are the nodes of concern currently focused?
The traditional banks are still certainly of focus because you do have these banks not only lending to small communities, but remember those small businesses were huge job creators in the United States that have faced pressures back to 2020, Lisa. We have to remember when we came into this how much pressure those businesses were still under even before any kind of credit crunch even started. Now, if you look at what has happened into the most recent weeks, you have Torsten Slok at Apollo saying credit conditions were tighter than they were since 2008, even before this banking crisis most recently started. There's some silver linings here. You think about what Jane Fraser told David Rubenstein last night about this idea about a few more banks potentially facing more pressures in the near term, but that not creating necessarily a nationwide credit crunch. And what that implies here is that there can be some more strain among these smaller banks without these systemic ripple effects, but that doesn't mean, to your point that you've been making, that credit won't be as easily available. It won't be as easily available as it had been in the past.
How does crypto fall into this? Because to some degree, Silicon Valley Bank was somewhat connected to it. We've seen others that had similar types of exposure. Now there's Coinbase that received some sort of SEC notice. Is there a unifying thread through these stories?
I think you have to look at them one by one only because it is the time to parse your client base, to parse their exposures and see what is going to make it through this crisis. Take PacWest for a moment here. You see that a lot of their deposit base was tied to the venture-backed community. They faced about 20% of their deposit outflows this year. A lot of that because of that venture tie. It wasn't enough to create really significant strain that you saw at some of these other firms. But then you look at First Republic, also kind of this California profile here, facing these dire strains at a much more massive scale. So we can say that we can loop these all together in one big basket. I think that's imprudent because you're seeing each of these firms face different lifelines from different types of investors.
Shnali, what are you watching in the days ahead?
Loan officer survey. Who's not?
Exactly. It seems like it's what is on everybody's mind. Shnali Bossack, thank you so much for being with us. Right now, we are looking at markets that have a lift, a bit of a reprieve after a couple of days of turmoil. Although we have seen that grind higher, it's almost as if people want to look past whatever is to come. People keep talking about potential weakness, and everyone keeps saying, no big deal. Right now, we're seeing the Nasdaq up about 0.9%, the S&P up about 0.5%. Yields just a little higher, no drama, even after better than expected data on the employment front, lower than expected initial jobless claims. Again, it's pointing to this robust labor market and a resilient economy. When does that change? This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Worries over inflation trumped the recent banking turmoil as Fed Chair Jerome Powell rejected the idea of rate cuts and said that more tightening may be ahead. Wednesday's quarter-point rate hike comes less than 2 weeks after the second biggest bank failure in U.S. history. The takeover of Credit Suisse has the big banks putting their de facto hiring freezes on hold. Bloomberg's learned that firms such as Deutsche Bank, Citigroup, and J.P. Morgan Chase are preparing to hire some of the Swiss bank's investment bankers and wealth managers. Talks have begun in London and New York, and some headhunters are even flying to Zurich. In France, more strikes are set against President Emmanuel Macron's push to reform the pension system. Public transportation, schools, and refineries are likely to be impacted. It's now been more than 2 months since French unions began a series of walkouts and marches. Macron wants to raise the retirement age from 62 to 64. Tesla has started a price war in China that's set to reshape the world's biggest car market. Elon Musk's electric car maker has cut prices twice since October. That's made some Tesla models almost 50% cheaper than in the U.S. The moves left rival EV makers in China with little option but to follow suit. At least 30 have cut prices. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Banking system is pretty sound, and we're talking about a few banks. We heard it from the chairman Powell today. This is not something that is spread across the entire banking system. This isn't like it was last time. This is not a credit crisis. This is a situation where it's a few banks.
That was Jane Fraser, head of Citigroup, speaking yesterday with David Rubenstein of Peer-to-Peer Conversations, as well as, of course, Carlyle down in Washington, D.C. This has been the big concern for a lot of central bankers coming out and saying that their financial systems are safe and sound and resilient. Norway hasn't had to deal with that as much. There hasn't been as much of a concern about Norwegian central banks. And sure enough, Norway's central bank came out this morning and raised rates by 25 basis points, the highest rates going back to 2009. And had a pretty hawkish tone. Joining us now to talk about it, I'm so pleased to say, is the governor of the Norges Bank, Governor Ida Woldenbach. And I'd love to get your sense, Governor, first of all, was there any discussion about going even further than 25 basis points to even 50 basis points based on just how hawkish people thought the statement was?
Well, obviously, we always have good discussions and consider different alternatives. But when we met yesterday, the decision to raise policy rates by 25 basis points was unanimous. We are also signaling that more hikes will likely be needed to curb inflation. And most likely, we will raise the policy rate again in May and then further to 3.5% in summer.
How much of a green light were you given by the fact that there has been some krona weakness, that you could basically see some strengthening and it would be a positive? It would actually bring down inflation. And so to be more aggressive at a time where there is this policy divergence in other regions of the world was a positive.
Now, obviously, the krona exchange rate, although we do not have a target range for the krona exchange rate, we have a floating currency. It matters for inflation in a small open economy. So the fact that we've seen a quite significant depreciation of the krona was one of the reasons why we now think it is necessary to hike more in order to get inflation back to target. Now, the currency going forward, there's considerable uncertainty about the outlook for the currency. But if the krona will become weaker than projected, then that could also call for a higher interest rate going forward.
So that is something that it's a consideration, an active consideration. Is there a particular level that, for example, the euro-krona match pair would be something that would be concerning for you, or on the flip side, would be the appropriate level of strength to offset some of the inflation that you're seeing?
No, so we do not have a target range for the krona exchange rate. That's one of the factors that we are considering when we're making our forecasts and making our interest rate decisions. And our forecasts are based on an assumption that the krona will appreciate somewhat going further. But if it turns out that it remains weaker than projected, then could in isolation point to a need for larger rate rises. But obviously the outlook is uncertain and we will always take into account a whole range of factors affecting the outlook before making a decision.
One thing that the central bank has talked about is the potential for a wage price spiral, and this is something that a lot of people have speculated on. Could we be getting into that kind of 1970s type of behavior? What would you have to see to make sure that you're not in some sort of wage inflation spiral?
So we're not seeing that now, but we are seeing that wage growth is on the rise, and expectation for wage growth this year have been revised upwards. We're expecting wage growth of around 5% this year. And obviously that is one of the reasons why we expect, without a further tightening of monetary policy, inflation to remain high for some time.
Do you see this inflationary push as something secular, that is something that is global and has not been stymied by the recent turmoil that we've seen in certain select pockets of the banking system?
I think the more underlying drivers of inflation before the pandemic and what a reversal of those drivers would mean going forward is a matter that is creating uncertainty about the outlook. We must be prepared for greater volatility in prices, and we will be prepared to do what we need to do in order to get inflation back to target.
Governor, how much do you look to other central banks around the world to determine your policy rate? How much is it important to understand whether if the ECB is raising rates, then you also have to raise rates in tandem because of the currency differential and because of just where we are in the inflation regime?
We are setting interest rates on the basis of the outlook for the Norwegian economy and for inflation in Norway. But as a small open economy and thereby the exchange rate matters for inflation, what other central banks do does matter, but there's not a mechanical relationship between the decisions taken by other central banks and our interest rate decisions. But what other central banks do will be one of the factors that we take into account when we make our decision.
Based on what you have seen over the past couple of months, do you think that it's more likely that you get to 3.5% for the sort of terminal rate, or that you get, basically even further because of some of the wage inflation and other pressures?
I think there are risks on both sides of our interest rate projection. We have not yet seen the full effects of the tightening that we have behind us. And we are expecting high inflation and higher interest rates to curb household spending. To what extent is still uncertain. And we are basing our forecast on there not being a significant tightening of financial conditions globally as a result of the recent turmoil. So there are risks on both sides of our interest rate projection, and the krona exchange rate is one factor that we will also be monitoring closely.
Governor Ida Woldenbach of the Norges Bank, thank you so much for being with us today after the rate decision earlier this morning. It seems like we have seen this ongoing divergence. Michael McKee tracking it all, Bloomberg economics and policy correspondent who joins us now. Mike, it seems like that's the takeaway over the past couple of weeks, that there does seem to be, under the covers, a bit of a divergence where you still see a hawkish tone from European banks and the Fed perhaps already seen the rate hiking cycle end.
Well, the Fed's very close to the end. They already think they're at least at restrictive, if not above it, and they want to get a little bit above it to bring down inflation, whereas the European Central Bank and the Bank of England may be a little bit farther behind. I always want to separate out the Bank of England because they have a different problem than the Fed and the ECB in that they're dealing with some of the after effects of Brexit, and they've got labor shortages because of that. They've got supply chain problems because of that. The ECB is really dealing with an energy-caused inflation spike, and the U.S. has a mixture of that and supply chains, but leftover stuff. And now they're trying to bring down inflation with high rates. They move first, so they're already there. The ECB is catching up fairly rapidly. So I think at this point, though, it is the Fed's that's closest to the end.
How much do you think that Jay Powell talks to Janet Yellen?
They talk at least once a week, we know. Beyond that, I'm not sure. And obviously, in the last 2 weeks, they've probably talked to each other quite a bit. Yesterday was kind of a confusing day, and there were a lot of mistaken impressions left by Yellen's testimony. The medium-sized central banks, you remember, sent the Treasury a letter saying we would like a blanket insurance policy for our banks for up to 2 years. And basically what Yellen was saying is we're not going to do that because that requires Congress to agree unless we decide there's a systemic emergency, and we don't think there's a systemic emergency right now. That just got reported as Yellen says there's no bank insurance coming, and that really upset investors when Powell was trying to say at the same time, your savings are safe. So there was some confusion there, I think, caused in the translation that the Treasury Department didn't really mean, and that's probably why they hadn't coordinated those thoughts between the two.
Michael McKee, thank you so much for that and for ongoing coverage throughout the week. In the tumultuous time we were expecting this rate decision, it was very hyped up. It came out as dry as stone, which is exactly what he wanted. And then it was muddied by Janet Yellen's discussions. We're going to keep that conversation going. Coming up on Balance of Power on Bloomberg TV and on Bloomberg Radio, Congressman Brendan Boyle at 5:30 p.m., a Democrat from Pennsylvania, also talking about what the potential is for deposit insurance, very much a focus on that, as well as on the Tic-Tac hearings in the House, which we were just talking with Senator Warren about. Right now in markets, you are seeing a bit of a lift. There has been an ongoing sense of optimism in markets, despite some of the bearish commentary on where this economy is going and perhaps a greater likelihood of a hard landing with rate cuts now priced into the market. From New York, this is Bloomberg.